All right, fools. Welcome to another hour of Fool24. I'm one of your hosts on deck today, Rachel Warren. I'm happy to be joined by Danny Venna for this hour. Danny, love the shirt. How are you doing today?
I am doing well. It's Friday. One of my favorite companies reported earnings that were better than expected, and it's one of the few green spots in my portfolio today. Life is good.
Ah, love to hear it. Our theme today, we're going to be talking about stocks that we would buy on the dip. And I think this is a really interesting topic as well because we're looking at a period where it's been a very interesting earnings season. There's definitely been, we've seen these trends where sometimes a company will report pretty solid earnings overall, and yet the stock takes a real hit in the days and hours after the company reports, maybe because the investors were hoping for more, or because one or two metrics weren't quite what Wall Street had been projecting. And we've also seen some companies that have remained broadly resilient through the earnings season, and it really goes back to that question of thinking about some of the factors that can drive stock price down. Just because shares go up or go down tells you very little about the actual business. It just tells you what investors think about that stock at any given point in time. And so it's always important to look behind those movements and to see, okay, does this pose a buying opportunity? What are the factors at play here? And, bear in mind, there are many factors that can drive a stock price down. Obviously, negative company news is one of the biggest ones we talk about, disappointment over earnings, but there can also be, different factors in the landscape in which that company is operating that can impact stock price. Think of things like rising interest rates, increased market uncertainty, certain trends within the industry in which that company operates might affect stock price and investor sentiment towards it. Really, any factor that would lead investors to perceive a company's future profitability as potentially riskier might cause the stock price to decline. But sometimes stocks will decline, and there's actually much more to the story that could present a buying opportunity for long-term investors. And I think all of us as long-term investors have our own ways of approaching that. We're not able to give personalized stock advice on this show, but I know that Danny and myself today will be talking about some companies that intrigue us and also what we think about when we're looking at the factors that are moving stocks down and whether we see that as a potential buying opportunity for different companies that we look at. So maybe to start off today, Danny, what are some of the things you think about when you see a stock that is on the dip that not only might induce you to want to buy the stock, but actually would cause you to keep away from it and say, actually, this isn't a great buying opportunity for my portfolio?
I think I'm going to take the second part of that question first. There was a great example that has come up recently of a stock that, in honor of David Gardner being on earlier today, I want to kick it off with a David Gardner quote, which is dips buy on dips. Now, there's a reason that he said that. Like Rachel said, there are a lot of reasons why a stock can go down. And sometimes it's because Wall Street is not paying attention, um, and or investors and analysts are paying too much attention to the fact that the company maybe didn't meet Wall Street's expectations. However, there are plenty of reasons why a stock might go down that should give investors pause. And the example that I want to use today is Super Microcomputer, ticker SMCI. For investors who may not be familiar with this company, it creates servers that are specifically designed to handle the rigors of AI. They use really high-end graphics processing units and other chips from really top-of-the-line makers like NVIDIA, ticker NVDA, Advanced Micro Devices, ticker AMD. And they build these servers just so that they can build AI models, run large language models, which really is beyond the pale of your average everyday computer. Now that may be changing, but for right now. So I want to go back to what happened. And I it was in probably, I want to say, mid last year. Um, Super Microcomputer had a number of things happen in very short order, which caused investors to abandon the stock. And I want to read from a list here. So the first thing that happened was a noted short seller called Hindenburg Research issued a short report that alleged that there were accounting red flags in their financials, a pattern of undisclosed related party transactions, product shipments that were made in violation of U.S. export bans. So it was a pretty scathing short report. Now, shortly after that, and talk about, adding fuel to the fire, Supermicro then said it was going to delay its annual 10K or its annual report with the Securities and Exchange Commission, saying that it required additional time to review its internal controls. Now, that's usually accounting speak for something in the accounting realm went wrong, something that was not supposed to. And they maybe didn't follow their rules, or they didn't have rules in place to keep those types of things from happening. Then there was a report that the U.S. Department of Justice had taken an interest, and that they were investigating allegations that were made by a whistleblower, according to a report that appeared in the Wall Street Journal. Stock price was falling. The company wasn't supplying its required, financial disclosures, its financial reports. Then they got a letter from the NASDAQ that said they were at risk of being delisted. And then one of the company's auditors, Ernst & Young, which is one of the big four accounting firms, resigned while preparing the company's audit. So to me, all of those things right there are huge red flags, particularly from an accountant's perspective. So when you're talking about buying on the dip, I just wanted to acknowledge upfront that there are many reasons that you should not buy on the dip. In fact, you should run screaming in the other direction. Now, I am a Super Micro shareholder. The stock has rebounded more than 100% from its recent lows, but I refuse to buy on the dip because there were too many. There's too much uncertainty. There were too many unknowns. And actually, we still don't even know yet if the company is going to be able to submit its financial reports in a timely enough fashion so that they don't get delisted. Now, they said they're going to, and the date for that is 25th, if memory serves, which would be next Tuesday. Supermicro says they're going to. We'll have to wait and see. So we've been talking a little bit about Supermicro, ticker SMCI. But this is a company that is a fine example of when not to buy on the dip. Thoughts, Rachel?
Yeah, I agree, Danny, and I think that that's why it's always so important to really dig into the details and see what some of the factors are behind those movements. Because I agree, sometimes a stock on the dip can be a great opportunity, depending on what one is looking for as an investor and what one's personal portfolio goals are. And sometimes it's a really great sign to stay far away. And usually it's in those types of situations, not where you've had maybe a single, financial report that had a few numbers that investors didn't like, but where there are a series of events like you laid out with this example of Super Microcomputers, where there's just too many red flags to warrant calling that a good opportunity to buy on the dip. Maybe to offer a little bit of the flip side of that, one company I've been watching pretty closely this week, as investors have been a bit unhappy with the company after its earnings report, is Walmart, right? So this is a pretty widely followed stock, I think, within the Fool universe. And, I saw some of the news about their earnings report, and then I dug a bit deeper into some of the numbers. And then I saw a story that, management had come out trying to sort of qualm some of the fears that had, I think, been expressed by some investors post the earnings report. So I thought it might be worth talking about a few of these figures and why I'm still looking at this stock as potentially a good opportunity, over the long run for my own portfolio. After Walmart stock, after they reported their earnings, the stock dropped as much as 7% in early trading, and they were on track for their worst trading day since November 2023. And it's worth noting that it was still a pretty robust quarter of earnings. So Walmart beat on both the top and bottom line, higher than what Wall Street had expected for their fourth quarter, as well as their fiscal 2025 results. So it was a beat both in terms of sales and earnings. Quarterly revenue increased 5.3% year over year to about 183 billion. Adjusted earnings per share were up 10%. Same-store sales for the Walmart U.S. division increased 4.6% in Q4. U.S. e-commerce sales actually jumped 20% year over year, fueled by continued trends like in-store pickup and delivery. And they also had a robust closeout to the year, given their holiday sales and the period in which that fell. And one of the comments that CEO Doug McMillon said when they reported earnings was, "We have momentum driven by our low prices, a growing assortment, and an e-commerce business driven by faster delivery times." He also noted that Walmart's continuing to gain market share and that they're in good shape with their inventory, which is a comment I'm definitely looking for from businesses like this right now, in a time where, consumer spending patterns are still broadly in flux. There are still concerns about inflation. And we've seen companies like Target, for example, have serious issues with trying to offload too much inventory. So that was a comment that I noted and appreciated. Walmart Plus, the subscription service that they run, saw actual double-digit growth in Q4. And then their membership and other income increased 33%. Now, their grocery business, right? So this is non-discretionary consumer spending. That makes up about 60% of their total sales in their US segment. And that saw a nice mid-single digit same-store sales growth. So the biggest issue that investors didn't seem to like after this report was that management forecast more conservative guidance for their fiscal 2026 than they had done in the previous few years. They're projecting that they're going to increase net sales between 3 to 4%. Now, that's compared to this fiscal year they just reported, where net sales for the full year increased 5.6%. So we're going from about 6% growth to 3 to 4%. This was the thing that seemed to be a real sticking point for investors, and that really, dragged the stock down after they reported. The CFO had commented that they've been operating in a highly dynamic backdrop. We know these are similar comments that have been made by other of these big box store retailers. They did affirm that they have maintained a relatively stable outlook in the macro environment, and acknowledge that there are still uncertainties related to consumer behavior. Now, it's worth noting that prior to their earnings report, Walmart shares had soared more than 70%. It was a really robust for Walmart and the maturity of their business year and Q4 of growth. And although they are forecasting slower growth, which I think a lot of investors and analysts see as more of a bellwether for the performance of the broader retail space, they still seem to be in a great position financially, a solid amount of cash on hand, and their core businesses are growing at a much faster rate even than their overall top line growth. And this is also a business that has a wide range of revenue sources. As I mentioned, in the US, for example, their grocery sales are a huge, huge part, 60% of their overall net sales. But they also make money from their membership programs like Walmart Plus and Sam's Club. They have, this whole advertising segment where they promote brands and retailers on their platform. And that has increasingly become an area of growth for the business. For example, in Q4, their global advertising business grew 29% year over year, which actually outpaced their global e-commerce sales, which grew 16% year over year. Their operating income was 2.3 billion for the full year. And looking also at the 12-month period, their ad business grew 27% year over year, and that was 4.4 billion. So still a small slice of their overall revenue of 681 billion, but a notable growth in that area. So for me, it was something we talk about a lot on this show is, we don't generally make decisions about our portfolios from, 1 or 2 quarters of financial reports. I was alarmed when I looked at how the stock was performing and some of the news that was coming out. And then once I dug a little bit deeper into the numbers, I was a little bit less concerned and really digging into the fundamentals here. The business still seems in solid shape. Operating cash flow for the year increased slightly. Free cash flow saw a slight decrease, but still came to about 13 billion. And they repurchased about 62 million shares in fiscal 2025. These are results that, for me, as I'm looking at a business like this, that has struggled in recent days following their report. It's worth noting the stock is still up about 60% over the last year. So this is not like a heavily beaten down stock by any means. But this to me is a great example of when we're in earnings season or outside of earnings season, when you see news that comes out about a business, to dig a bit deeper. A company like this might not be for everyone. Retail stocks are not everyone's favorite choice, or may not fit with everyone's risk tolerance level. For me, as there's some of these companies that I tend to like, as I diversify my portfolio, my thesis about this company in particular has not shifted from this quarter. I will be watching their upcoming financial reports very closely, because I do think that Walmart's financial results very much tell the tale of what is going on behind the scenes in overall consumer shopping behaviors, particularly in the U.S. retail space, and as it pertains to even non-discretionary purchases like grocery. So those are things to watch. Still a company that I like, and in my opinion, is solid overall. But I will kick it back over to you, Danny, and then maybe we can get into some of the questions that are coming in.
Yeah, actually, I can, maybe kill two birds with one stone, as it were. So we had a question 7 minutes ago from Addie. Thoughts on Root, UNH, and TTD. Now, to be fair, I only cover one of those, so that's really the only one that I will address here. It's the only one that I really feel confident in addressing here. But the trade desk really has done a remarkable job since they went public in being very consistent in delivering consistent results, really. The company is the leader in programmatic advertising. They've done a very good job of, working with the largest ad agencies in the world, and making sure they get what they need. They help them with their targeted advertising. They have built a platform that lets the advertisers basically go on there and do self-serve ad campaigns. But because the trade desk has gathered so much information, and because they have so many partners, they have a system that is really hard to beat in terms of targeted advertising. Now, what happened recently is that the trade desk stumbled a little bit in the most recent quarter. They announced that they didn't hit their own internal goals. They essentially were focusing on expanding into new markets, but they let slip a little bit on their day-to-day. And as a result of that, they have a fair track record of increasing their revenue year over year, and accelerating revenue. And actually, this time, their revenue actually was a little bit slower than the year ago quarter. And so the market was pretty brutal. I mean, it sold off like 33% in a single day. Right now, the trade desk is down about, let's see here, percent off high. Oh, look at that. The stock is actually down right now about 48% off its peak. Now, I do want to share two charts here on the trade desk. So I'm going to share my screen here for just a moment. And the first chart that we're going to show is the trade desk's stock movements percentage off its high. And this is going back to the company's IPO in 2016. Now, if you look at this chart, you can see that's a pretty brutal decline rate here that happened recently. But if you go back, there's a pretty notable decline here. There's a bigger one here. There's one here and here and here and here and here. What this tells you is that the trade desk is a volatile stock. And as a result of that, being a shareholder in the trade desk, I have to be ready to endure these precipitous declines like that. Now, what I want to do is I want to change this chart for just a minute and really show you what the trade desk has done in terms of the stock since 2016, even after that drop. You've got a stock that has returned 2,320%. Now, you'll notice this decline that we're seeing right here is probably its second worst decline here, like this one in 2022. I don't think that decline was warranted. So if the trade desk was not already my seventh largest position and representing about, I want to say 4% of my overall portfolio, I would not have any qualms with adding to the trade desk at this point, simply because the company has such a long track record. I have a lot of confidence in CEO Jeff Green, and it's a company that, yes, it has stumbled before, and the stock price has gone down before, and it always has come back and reached new heights. So those are my thoughts on the trade desk. And I think, in my opinion, is one of those companies that is a great example of when to buy on the dip.
Yeah, and I can actually grab one of the other stocks that was in that question. I don't really know much about Root, but UNH is the ticker symbol for UnitedHealth Group. So obviously, this is a company that's been in the news a lot this year. The stock has been beaten down for a few reasons recently. I believe the last time I checked, shares were trading down about 9% from the beginning of the year, about 12% from 1 year ago. But the biggest thing that's moving the stock right now is there was a report that came out from the Wall Street Journal that alleges that the U.S. Department of Justice is investigating UnitedHealth's Medicare billing practices. Now, there have been a lot of allegations and even past probes concerning some of this provider's billing practices in the past. They're certainly not the only company in this space that has dealt with these kinds of allegations and issues. For UnitedHealth's part, they did say that they were unaware of any new probe underway at the time the story broke. This is something that is still in progress. This story just came out today, I believe, so it's something that I'm watching pretty closely. Their shares fell about 9% today, and that weighed a bit on the Dow Jones Industrial Average, which was down about 1% as of earlier today. And there's also been other companies that are in the insurance space, like CVS Health and like Humana, who have also seen shares hit a bit on this news. There has been, according to the Wall Street Journal, there's been a civil fraud investigation that is examining UnitedHealth Group's practices for recording diagnoses that trigger extra payments to their Medicare Advantage plans. We will see how this develops. We know that also shares have come under pressure since the death of the CEO in December. And then there have been numerous setbacks for UnitedHealth through the years, given some of the investigations it's gone through. These are things that I'm watching. I do cover UnitedHealth fairly frequently. Looking at it from an investor and from a business perspective solely, it's kind of important to understand that they have these two main businesses, right? They've got United Healthcare, which is that flagship insurance business that everyone is familiar with, where they earn revenue from premiums paid by individuals, employers, as well as through governing entities like Medicare and Medicaid. And then they have their Optum business, which provides a range of direct care services, software and analytics services to healthcare providers. And there's also their pharmacy benefits management business, which is encapsulated within Optum. So there's really a wide source of revenue for the business. This is a company that has been habitually very profitable, solid cash position, and revenue growing steadily. So from a financial position, the company has remained in solid shape. Some of the factors moving the stock right now, or what I was explaining with this most recent story about a potential DOJ probe. And as mentioned, the company has been the subject of some, investigations and allegations concerning these billing practices before. For me, as I mentioned, this is a company I cover quite a lot. I am not taking a position in the company at this point. I want to see how this story, which is very much developing, shapes up. But as is often true with some of these large health insurers that we see, probes and other stories regarding, these are companies that are often in very strong financial positions, like UnitedHealth Group. They have a significant amount of cash on hand. They are well fortified to deal with any potential legal or regulatory headwinds that may come their way. So those are just maybe some factors to consider and my thoughts on the company right now. We actually had a few questions that came in about Celsius. So Aaron with No Bush said 3 hours ago, thoughts on Celsius earnings yesterday. Instead of being acquired, they are doing the acquiring. We talked about this quite a bit yesterday, but I'll share a few thoughts on that, and then I'll kick it back over to Danny to look at some questions. But I actually think this is a really good move for Celsius. I think that one of the things that Celsius and some of these other energy drink companies have been dealing with issues about recently is there's just been a really significant shift, I think, within the consumer space to search for, healthier options. Now, obviously, Celsius is known for, their lifestyle drink Celsius, which is zero sugar alternative to traditional energy drinks. But even so, there has been changing consumer dynamics for companies like Celsius recently. And I think Celsius has taken note of that and is really working to diversify the types of offerings that they have. For example, shortly before they announced their earnings, I believe a couple weeks ago, they announced that they were going to be getting into the hydration electrolyte powder space, which is a multi-billion-dollar market just in the US. That was something that I found really interesting. And then, of course, they announced yesterday, right before earnings, that they're acquiring Alani Nutrition as they work to create a much more all-purpose, all-in-one functional lifestyle platform. And it's worth noting that Alani Nutrition, which they are in the process of acquiring, they sell energy drinks, healthier, alternatives to energy drinks like Celsius, but they also sell a wide range of other health-centric products, including, whey protein, greens. They sell some kinds of coffees, protein shakes, a much wider assortment of health-centric products than Celsius has previously offered. So I think this is very much a part of their overall long-term strategy to diversify their business model. So perhaps they're not so reliant on the US energy drink category, which, as we've seen from other companies, like Monster Beverage, for example, have been dealing with really shifting shopping patterns from consumers who are, widely speaking, I think increasingly more health conscious. It's also worth noting that Alani Nu has always been positioned as a female-focused brand for a growing community of Gen Z and millennial consumers. And I think that Celsius is really trying to reach out to unaddressed areas of its consumer market, which I think is notable. I think this is really good news. I think it was a pretty solid also financial report that the company delivered yesterday. I think that The only thing that really stuck out to me was, they reported a net loss in Q4, but they were still profitable in the full year, even though their bottom line has been under pressure, particularly as they've been dealing with issues from their main distributor, PepsiCo, which again, I think moving to broaden their horizons and perhaps not have such the reliance that they currently do on just a very small group of products, I think is key. So overall, I thought it was a good report. Their gross margin was up 220 basis points in the year, which I thought was an improvement. The top line was up 3% for the full year, and their category market share grew by 160 basis points. So I think this is a company in transition right now. I think that this acquisition is evidence of that. I think we're going to have to wait and see how that translates into their financial performance. We know they've been having issues with their distribution partnership with PepsiCo, but they also noted that in 2024 they increased their total points of distribution by 37%. So I think there's a lot of opportunity still for this company, and even more so now that they're tapping into a new potential market.
Very nice. So we had a question come in from Matt a few minutes ago. It says, Danny, does the trade desk pass David Gardner's SNAP test? Now, that may not be a concept that all of our viewers are familiar with, so I'll just give a quick rundown. So David Gardner says, what if you had the power to snap your fingers and make any public company disappear? And he gives a few examples. Now, the two that stand out most for me, one example is Amazon. So if somebody snapped their fingers and Amazon disappeared off the face of the earth, would anybody notice? Or would anybody care? And I'd say the answer to that is yes. I think the same thing would be true for Alphabet, Google. What if you went to do an internet search one day and all of a sudden Google was gone? So I think the point here is that would it be consequential? Now, not everyone is going to have the same type of impact as, say, an Amazon or an Alphabet, ticker AMZN, ticker GOOGL, or ticker GOOG, depending on which class of Alphabet shares you might own. Now, if you're the average consumer, you're probably annoyed by commercials. Not everybody. A lot of people see them as a necessary evil. When streaming came out, many people forecast that was going to be the end of commercials as we know it. And as streaming services began raising their prices, consumers decided that perhaps they could put up with some commercials if it meant saving money. But it's less of an issue when you see these advertisements that have meaning to you, that may be about something that you care about, rather than, I'm probably not interested at my stage in life in commercials about baby food or diapers or things of that nature. My kids are grown. So what I would say is that the trade desk is the biggest partner with all of the major ad agencies, all of them, bar none. And it gives them the tools that they need to make sure that their targeted advertising is effective. It's programmatic, which means they go through trillions. And let me say that again, trillions of permutations each second in order to make sure that they match the ad with the right consumers. So I would say, based on my knowledge of the company, if all of a sudden all the world's major advertisers all of a sudden could not match the ads that they were putting out with the consumers that they were meant for, I think that would have a huge impact on the advertising industry. So while the average person on the street might not notice, I guarantee you that the ad agencies would notice. So from that perspective, I would say, yes, the trade desk does pass David Gardner's snap test. This leads right into another question that included the trade desk and also Datadog. Besties said a few minutes back, is it time to sell the trade desk and Datadog, tickers TTD and DDOG? I'll start off by saying we cannot give personalized investing advice. But if I go and look at the results from these companies, the first thing I'm going to do is to look quickly at the trade desk. Revenue grew by 26% in 2024. Their diluted earnings per share more than doubled. They continued to take market share from their competitors. Customer retention, which means the number of customers that they had this year compared to last year, stayed over 95%, which means they keep 95% of their customers, and they have for every year for the past 11 consecutive years. Now, just those high level things right there tell me, for me, I don't see any reason to sell the trade desk. I think that question is being asked because the trade desk stock is down. But let's not confuse a stock price being down with the company's performance. Yes, their growth did slow down a little bit. Yes, they have a few things to work to, but given their track record, I know that I'm certainly not selling my the trade desk stock. One other thing that I wanted to share here is a chart that shows the trade desk performance since the company went public in 2016. So I want to share this chart here. And what this chart shows you is the trade desk's percent change in revenue, in net income, and in the stock price. And as you can see from this chart, the company's stock price has grown by over 2,000% because its revenue has grown by more than 2,000%, and its quarterly net income has grown by more than 2,000%, all since 2016. Based on that, and if you look at the chart here, the one thing that I see right here is that revenue went up, net income went up, stock price went down. My view on that is that investors overreacted to the news. Now, to be fair, the stock price had a high valuation, and that tends to produce volatility. That said, I don't see any reason that I personally would sell the trade desk. Now, the other company in question was Datadog. For viewers that might not be familiar with Datadog, if you are a company that has a website and your website is an integral part of your business and you cannot afford to have your website go down, many companies turn to Datadog. What it does, it integrates with your company systems. It monitors your website and the things that are going on in the background with your website, so that if there's an issue that could cause a critical amount of downtime for your website, for your systems, for your customer-facing systems, then it will notify you if it sees an anomaly so that you can fix that before your website goes down and you end up losing sales or business because customers can't get to your website. Now, I went and looked at Datadog's most recent results, which came out a couple of weeks ago, or actually a little more than a week ago. Their revenue grew 25% year over year. Their net income grew. Their operating margin was fine. I think the biggest thing that we saw was that it was not as robust as perhaps what Wall Street was expecting. But the company is building a strong base. Has 462 customers that have annual recurring revenue of $1 million or more. That was up 17% over year. You love to see annual recurring revenue growing, because that means that for every quarter going forward, you're going to have a higher and higher and higher revenue base. Now, when you look at their outlook for the first quarter of 2025, they said that they were going to have revenue of about 739 million. Now, that was barely over what they did in the fourth quarter, which means they're expecting their sales from quarter to quarter to be essentially flat. This is seasonally a slow season for them, so I don't see that as an issue. But let's look at the same chart that we looked at for the trade desk, and we will look at Datadog and see what that chart tells us about their performance. So I'm going to share my screen once again, pull up Y charts here. And what you see here on this chart is that Datadog has grown its revenue by 700% since it went public in 2019. It has grown its net income by 5,000%. And its stock price is only up 224%. Now, for me, looking at that chart, what I see is a stock price that is not keeping pace with the revenue and the earnings growth. And generally, what happens over time in those situations is the stock price tends to catch up with the revenue and the income growth. So from my perspective, I don't see any reason that I would sell the trade desk or Datadog personally.
Awesome. Thanks, Danny. Those were great deep dives into those companies. So there were a few questions I wanted to hit. We had a question from Archana or Arcana. Is Deckers in the buy zone? Deckers Outdoor, we can't give personal investing advice, but I can share my thoughts on this company right now. For anyone that follows Decker Outdoors, let me actually tell the exact amount of how the stock has been performing. So the stock is down about 28% from the beginning of the year. And this is despite the fact that actually in their recent earnings, which they reported at the end of January, they beat analyst estimates, and management very clearly stated that based on the numbers they're seeing, they do not see demand going down for their shoes. Now, again, Deckers Outdoor, this is the company that sells brands like Hoka, UGG, Teva footwear. And just to kind of give you a little bit more color there on like what those numbers actually look like. So this was their financial report for their third quarter of fiscal 2025, right? So this was a quarterly report, not one for their full year yet. But their overall net sales increased 17% year over year to 1.8 billion. Direct to consumer net sales increased 17.9% year over year to a little over 1 billion. Their domestic sales increased about 12%. International sales increased about 29% year over year. Operating income also grew in the same quarter last year. That figure was about 488 million. In their most recent quarter that they reported, operating income was 567 million. Now, broken down by brand, UGG and Hoka remain the top selling and fastest growing brand categories for Deckers Outdoors. The UGG brand saw their net sales increase 16% year over year. Hoka saw brand net sales increase 24% year over year. Now, there was a slight decline in their Teva brand net sales, and then other brands, which is smaller and third-party brands, decreased about 16.6%. But those core brands, UGG and Hoka, both grew by notable double digits. They also offered, guidance for their full fiscal year, which their fiscal 2025 ends on March 31st. So you can expect their 2025 report to come out sometime this spring. But they are forecasting an operating margin of about 22% for the 12-month period. They're also forecasting full year net sales of about $5 billion, which would be a 15% increase from their fiscal 2024. I also want to note this is a profitable company, which is something I think that's important to underscore. In the first 9 months of the company's fiscal year, they reported net income of approximately $815 million, and that was compared to about $632 million a year ago. So this is an example, I think, in my opinion, of why the stock has been hit so hard. This is a company that's still doing really well from a financial perspective. The Teva footwear brand has seen some lagging growth recently, but those core Hoka and UGG brands continue to grow at a really steady, excellent pace. The company is very profitable, growing their operating income, and their overall net sales are also experiencing double-digit growth. And the other thing that I think is, again, worth noting is they're both domestic as well as their international sales are growing at a solid clip. This is, again, the shares that have been beaten down. They traded down, I believe, about 20% shortly after the company reported. And I think there's just overall some concerns about, how consumers are going to be spending on things like UGG and Hoka, and Teva products in the new year. But again, this is a company that beat both on the top and bottom lines. And that sales growth forecast for their fiscal 2025 of 15%, that was a raise from their previous guidance of 12%. So for me, this is still a company that I think is in pretty solid shape. As I mentioned, management has been pretty good at outlining that they're still seeing really solid demand. Now, again, if you have a situation where the macro environment turns, obviously, this is a company that is very much facing a discretionary market and sources of spending, but they're in a good financial position. So given how shares responded after their earnings, despite the beat and raise that they reported, seems to be not at all commensurate with how the company is actually doing by the numbers. There was another question that came in asking about Costco from Logical Dreamer. Is Costco, still a buy at this level? Again, I'm happy to offer my thoughts and my personal opinion on Costco as a company that I talk about a lot. This is a company that's still doing also extremely well. They've had strong sales growth. They are always reporting well over 90% membership renewal rates in their key markets. Again, most of their Costco warehouses are located in North America, although they do have an international presence. The stock is actually still trading up about 41% over the last year, even though it's been beaten down a bit over the last week. So that is something to note. This is still a company that's up double digits over the trailing 12-month period in terms of share prices. But they recently released some financials just for the first month of 2025 They do this regularly, and this helps give investors a really, I think, bird's eye view very consistently of how the company is doing from a financial perspective. They reported net sales of about $19.51 billion, which was a 9.2% increase from January 2024. And then in the first 22 weeks of Costco's fiscal year, they reported net sales of about $114 billion, which was up 8% year over year. For what it's worth, analysts are estimating that Costco will increase their revenue by about 7% in their fiscal 2025 and 2026, which is pretty well in line with the growth rates that Costco usually reports, given the size and scale of its business. This is, I think, a business that has shown really marked resilience, even as the retail landscape has been shifting. You think of companies like Target, which as an income investor I like, but the business has been struggling significantly the last few years. Costco has continued to report really steady growth on both the top and bottom line. Its membership renewal rates are substantial. And again, this is a company that makes most of their profits from their membership fees. So because they negotiate these really low prices for their products, they pass those savings down to the consumer. They have very slim margins on their sales of products that they sell in warehouse. So even though most of their sales come from sales of products and services, most of their profits come from their membership fees, which remain steady and experiencing really high membership renewal rates. So for me, this is a stock. My thesis has not changed on it all, and maybe those are some factors to consider for anyone that follows this stock closely.
So I'm going to knock out a couple of these really quick, Rachel. David Dudash asked a few minutes ago, any idea why Hims and Hers, ticker HIMS, is down so much today? Well, it turns out that the FDA said that the shortage of Ozempic is over. And so what you're seeing is Novo Nordisk is up about 6%, and Hims and Hers is down 15%. And what has happened is, these weight loss drugs, which are really popular, there was a shortage of them. And as a result, I guess Hims and Hers had plenty of supply. And so they were able to pick up a lot of business while Novo Nordisk, not so much. And now that the FDA is saying that the shortage is over, the stocks are basically just reacting to that news and adjusting accordingly. The other question that I wanted to hit right quick was from Logical Dreamer. With the fall in Google stock, ticker GOOGL, is it worth a long-term buy? I think what has been holding Alphabet back is the fact that the company lost a court case. And so one of the potential outcomes is that Google could be broken up, or Alphabet could be broken up. Now, you've got Google, which is the leading provider of search worldwide. As of January, they had about 90% of the worldwide search market. They are the third largest cloud provider in the world, behind just Amazon and Microsoft. Their digital advertising business is also the largest in the world. So these fears of the company being broken up, I think, are investors should probably think about that a little deeper. If you own a company that has several really high performing businesses, and then the company gets broken up, then you own three companies that have really high performing businesses. So in my opinion, even if Alphabet were to get broken up into several parts, or if regulators decided that they needed to share some of their underlying algorithms to competitors as a result of what they were convicted of monopolistic practices. There we go. I don't see any issues with owning Alphabet stock long term. I am a shareholder. I think investors have overreacted to the results of the court case, and I think it represents a pretty compelling opportunity right now. The last time that I looked, and I'm going to look again here real quick just to see, but Alphabet stock right now is trading for about 29 times forward earnings. So that's a pretty fair price for a company that continues to grow at a remarkable rate and is the undisputed leader in two industries and a compelling competitor in a third. So I think that Alphabet is a long-term buy, but that's my opinion. Rachel?
I love Alphabet as a shareholder. Yeah, my thesis on that business has not changed. There's another question I wanted to hit from T Stock 18 minutes ago. Etsy has dipped about 33% on the year. Thoughts? Yeah, I was following this company, especially in recent days, as they released their financial results for 2024. I will note I am a shareholder in Etsy. I have been a shareholder for a number of years now through the ups and downs. I am not adding to my position right now, but I am still holding on to my shares, just to give a little bit of a backdrop there. But Etsy had a kind of a rough 2024. They have been dealing with issues from real decelerated growth compared to the pandemic period. Given their focus on vintage, unique, handmade, and goods that are designed to be an experience where you can buy items maybe you wouldn't find anywhere else. They are really very much subject to discretionary spending from consumers. Something that Etsy's management has alluded to a lot is that the pressure of consumer discretionary spending has continued to really weigh negatively on the business. So, just to give you an idea, in Q4 of 2024, their consolidated gross merchandise sales were 3.7 billion. That was actually down 7% year over year. The Etsy marketplace, which is the biggest part of the business at this point, even though they own other platforms like Depop. Gross merchandise sales on that platform were 3.3 billion. That was down about 9% year over year. And they also noted, management said that Etsy Marketplace GMS was weak on a year over year basis in October and November, but that they saw more acceleration in December. They also reported active buyers of about 89.6 million. That was a slight decrease of about 2.6% year over year. On a more positive note, they reactivated about 9.8 million lapsed buyers on Etsy. So this is something that they have been reporting a lot recently, is the fact that they have been continuing to reactivate buyers that maybe shopped on the Etsy platform a long time ago, haven't made a purchase on the platform in a long time, and then have decided to shop on the platform again. So that's something that I think is positive and worth noting. But again, this is a company that is really struggling with growth right now. Their consolidated revenue was up about 1% year over year. They did actually report a profit in 2024 of about 303 million, although that was a slight decrease of 1.4% year over year. So bottom line for me with this business as a shareholder, growth has slowed a lot. I think there's an opportunity for the business to do a turnaround, especially when and if consumer spending accelerates. And we've seen very much a trend the last few years where I think consumers are prioritizing spending on experiences, as evidenced by how companies like Airbnb and Booking Holdings and some of these other travel-oriented businesses are performing. They're prioritizing that as compared to spending on things. And that is a trend that we have continued to see bear out in a lot of companies' recent financial reports. So bear in mind, revenue is growing very slowly. Consolidated revenue, gross merchandise sales are down. The company's still profitable, but net income has been down slightly in recent reports. They're reactivating a lot of buyers, but active buyers and sellers are also down slightly. This isn't a stock I would be adding to right now, but as I mentioned, because it's a relatively small portion of my overall portfolio, I'm willing to hold on to my shares to see how the business and if they affect a turnaround in the coming quarters and over the next couple of years. If or when that does or does not happen, then perhaps I will revisit my thesis on the company.
Well, Rachel, we are at the top of the hour, and my understanding is that you're going to stay here and be joined by, and there he is.
There we go.
Our fine fool and drug aficionado in a good way. I'm Brian Morelli.
Thanks, Daddy.
Have fool on, guys.
Well, hey, Brian, how's it going?
Good. How are you?
Good. Good to be on with you.
Busy week in healthcare.
Very much so. Well, fools, welcome to another hour of Fool24. I'm staying on for this next hour. I'm joined by our resident biotech specialist, Brian Morelli. So really excited to talk about what has been going on in healthcare. I know there have been a lot of, biotech businesses as well as medical device and pharma businesses, which I follow more closely, that have or are about to report earnings. It's an exciting time to invest in and follow this space. So, Brian, I'm curious to hear from you as we kick off the hour. What are one or two companies that you've been watching in terms of news, earnings, or any other updates of note?
Yeah, so this morning, Bluebird Bio announced that they're getting bought by a private equity firm. The
Oh.
shares are down. Let me look. They're being sold for $3, but there's a contingent value right attached to it. So if their Bluebird's drug portfolio achieves $600 million in net sales in any trailing 12-month period prior to the end of December 31st, 2027, investors will get another $6.84. So, and the shares are down $2.82 down to $4.21. So, you
Wow.
get you guaranteed the $3, and basically the investors are valuing that $6.84 at $4.20. So they, I mean, obviously some of it's got to be discounted because you're not necessarily going to get it for a while, maybe potentially a couple of years. So you got to discount that in terms of the valuation, but it's still saying that investors don't necessarily think that they'll be able to achieve that $600 million milestone payment. So, this has been a really, I mean, I've never owned Bluebird Bio, but I can imagine for investors has been a pretty disappointing stock. It was I mean, they got a drug approved, and it was great, but they just haven't been able to, perform very well, in terms of getting their gene therapy sold to invest to patients, and that's been a concern of most gene therapies. We can talk about BioMarin, who released earnings today or this week, and their gene therapy for hemophilia has done really horribly as well.
Mm.
And so, it's really hard when you have these high value drugs that seem to be cures, but because they're one-time cures, they have to charge quite a bit for them, in the millions of dollars. And then you've got an insurer who is going to pay for that one-time cost, but not necessarily benefit from the one-time, from the ongoing lack of costs for treatments. Like for instance, in hemophilia, these patients are taking anti they're taking the protein that is missing that allows the blood to clot, right? And so instead, so that for the gene therapy, it's expressing that protein all the time, so they no longer have to take these drugs. So in theory, the insurance company can make back up that $1 million payment because they're not having to pay for these clotting factors for the rest of the patient's life. But in reality, that insurance company is not necessarily going to be the company that insures the patient for the rest of their lives. And so it becomes challenging. What is the insurance company has to pay up front, but doesn't get the benefits necessarily for the rest of their life, the rest of the patient life. And so it's, I think ultimately we're going to have the government step in here. And, once we have enough different gene therapies that are all approved, I think that that'll probably be what ends up happening, is the government ends up creating a pool that insurers pay into, and then the pool pays for the gene therapies, and then and then all of the insurers end up benefiting from the patients who are cured on those things. And eventually, hopefully, it works out that you paid for a portion of everybody's different gene therapies, and then you get some of those patients end up on your system for different amounts of time, and now you're benefiting from, the insurance company is benefiting from those. So I think that's probably what's going to end up happening, and just it's going to take a while for us to get the government to set it up.
Yeah, it was interesting. I have followed Bluebird Bio a little bit from afar, but one of the things that kind of stuck out to me was their gene therapy for sickle cell disease, which I think only generated about like 10 million in revenue as of their recent report. That was approved right after Vertex and CRISPR Therapeutics gene editing therapy, which is also designed to be a one-time functional cure, not just for sickle cell disease, but also for transfusion-dependent beta thalassemia, was approved. And they are, again, the uptick of actually adoption of that therapy is slow because, as you mentioned, there's such a deeply involved process with that. But something that has been interesting to watch, because there's still so few of these gene editing therapies that are even approved. Cascavy is already approved in numerous regions, including in the US, Europe, and the Middle East. Vertex has already established a network of authorized treatment centers. They're working actively with payers to secure broad reimbursement, because I believe the cost of a single therapy is upwards of $2 million per therapy. But kind of as you alluded to, it's a very lengthy process in which there's these stem cells that are taken from the patient, they're modified, they're infused back into the patient. So for these two ailments, the design is for them to help the patient produce higher amounts of fetal hemoglobin and delay or eradicate these very painful complications of these two rare blood disorders. But in practice, even just for a single patient, I think it takes up to 8 weeks just to administer a therapy to one patient. So it's exciting to see how the landscape for these types of therapies is evolving. But even when you get an approval, it's not like you're going to see a financial impact on a company's balance sheet very quickly. And just the rollout itself can be an even bigger challenge.
Yeah, and I sort of thought that they might do better in Europe because of the one payer system, right? So then that problem that I just described, it doesn't happen when there's a one payer system, and the government can easily see that spending the money now is going to benefit them in the long run. But at least for Bluebird Bio, they ended up abandoning the Europe. Now that wasn't for sickle cell disease. They weren't approved for sickle cell disease. They were only approved for beta thalassemia, and beta thalassemia is a little bit different because it's the cost is not that high because they don't have the complications that sickle cell patients do. They just basically have to get transfusions every so often. So the cost benefit maybe wasn't as good for beta thalassemia as it could be for sickle cell disease. But at any rate, they ended up abandoning Europe and stopped trying to sell it there. So it's little. I mean, like I said, I sort of feel like Europe is going to be an easier model for gene therapies and CRISPR therapies than for the U.S. model until we get some sort of government interaction.
Yeah. Yeah, absolutely. Maybe I'll talk about one of the companies I'm watching that has not yet reported yet. And they're not a pre-revenue business, but they are very much in the early stages of reporting any kind of revenue whatsoever, mostly from agreements that they have inked with government entities. But Relay Therapeutics is a company I've been following a bit more recently. They actually just announced that they're going to report next week. And essentially, they develop precision medicines for cancer treatment. Their lead candidate that they are working on developing is it's called RLY 2608, and essentially it's designed to treat patients who have metastatic breast cancer with the PI3Ka mutation, so a type of advanced breast cancer where the tumor cells have a mutation in that gene. And what's interesting is in their more recent report, which they released in November, they reported updates on the ongoing clinical trials for the specific candidate. And that candidate demonstrated a 9.2-month median progression-free survival rate in patients who had this type of breast cancer, who had been heavily pretreated with other regimens of therapy before, and also had this PI3Ka mutation. And so it's interesting because I follow companies like this a lot. I talk a lot about these really big businesses like Pfizer that are known for their major cancer and oncology portfolio, their CDK4/6 inhibitor like Ibrance. But when you're looking at some of these other smaller businesses that are also working on potentially like life-changing treatments for these types of mutations and HER positive, HER2 negative metastatic breast cancer, which is one of the most common types. This is something that I'm following just very closely. I don't have shares of this company right now. They're a very small business and they're barely reporting revenue at this point, although they did have about $840 million in cash on hand at the end of their recent quarter. So this is one I'm sort of sticking a pin in and watching their upcoming report next week. So wanted to quickly hit that.
So they're still in clinical development of the candidate. It's just so the revenue is only from is it's it's not every quarter. It's whenever
Research
they end up
funding, yeah,
getting whenever they end up getting payments. So
correct.
yeah, sort of want to discount that as a that don't use that for your valuation.
No,
Use
it's not technically pre-revenue, but it's almost pre-revenue.
yeah. I don't call that revenue. I just call that money that they're getting from
It's money that's on the
collaborations.
balance sheet. Correct.
Yeah. I mean, I guess it's good because it's cuts the cash burn a little bit, but in general, it's you can discount it in terms of valuation. You want to use that to figure out the you want to use the potential sales in the future, and then come back and then uh, work backwards to figure out what the current valuation should be.
Yeah, absolutely. And then one other company that I hadn't talked about a lot that actually reported earlier in the month, and then I'll kick it back over to you, Brian, before we maybe get into some of the questions, is Eli Lilly. We've been talking a lot about the GLP-1 drug craze. Eli Lilly is a company that I am a long-term shareholder of, and obviously, I think a lot more investors have been paying attention to the business recently because of the success that they have experienced with Mounjaro and Zepbound, their GLP-1 drugs for diabetes and weight loss management. But this is a company that is not only one of the oldest pharmaceutical businesses around, but they already have had and continue to have a really extensive portfolio of blockbuster drugs, well outside of their GLP-1 product portfolio, which I think is worth noting. They also garnered approval for a drug called Kisunla last year, which is the launch of which is still underway in numerous key markets. For example, it was just approved in China. And this is a treatment for early symptomatic Alzheimer's disease. This was an approval that had been long awaited for and could potentially be have major disruptive potential within the Alzheimer's care market. So that's one that I'm very closely watching the rollout of. But just looking at their results for Q4 of 2024, they brought in about $14 billion in revenue in that 3-month period. That was up 45% year over year. Their net income was about $4.4 billion for the Q4 period. That was up 101% year over year. And some of these other blockbuster drugs that they have, Trulicity, which is actually a GLP-1 that helps treat diabetes, Jardiance, which is also a diabetes drug, Verzenio, which is used to treat various types of cancer, including patients with metastatic breast cancer, Taltz, which is a monoclonal antibody that is approved to treat various ailments, including psoriasis and psoriatic arthritis. So this is one of those companies that I intend to hold on to forever, but it has been a really significant performer just from a financial perspective. And obviously, the growth and addition of drugs like Mounjaro and Zepbound to its portfolio have been a major needle mover. But the potential of its drug Kisunla, which I just mentioned, which is just really in its early stages of rollout, I think could be another huge opportunity for the business. They also just garnered approval for a drug called Omvo, which is designed to treat moderate to severely active Crohn's disease in adults. And they also have reported that they had a recommendation for approval by the European Medicine Agency. So there's a lot of really good updates with this business right now. They're in a solid financial position, and they are working on also acquiring a company called Scorpion Therapeutics as they work to build out their portfolio of oncology drugs. So this is a company that I find really fascinating, and as a shareholder and just looking at its place within the broader healthcare space. It's also worth noting that Zepbound, their GLP-1 drug, they are studying this drug and the active ingredient, which I believe is called tirzepatide, for various indications, not just diabetes care or weight management. For example, they're studying Zepbound in the US for moderate to severe obstructive sleep apnea in adults who have obesity. So there are a lot of other ways in which these drugs could have potential to disrupt disease standards of care, I think, in the next 5 to 10 years and beyond. And I'm keeping a close eye on this company's pipeline. There was a news story that came out today that was dragging some of these GLP-1 related stocks down, like Hims and Hers Health, which is obviously a big telehealth business as well, that there's no longer a shortage of GLP-1 drugs. But that's great news for companies like Eli Lilly, like Novo Nordisk, and anyone else that is working on some of these formulations. I think that there's still a lot of potential for growth there, even though there's not a shortage anymore. There are so many different potential disease areas where there could be use cases for these products. So this is one I'm watching, and I think it was another stellar year for the business, and watching closely some of these potential pipeline candidates as we go further into 2025.
Yeah, I mean, I think a couple of things. I think, it's the lack of a shortage is because they increased production,
production.
not because sales, flattened out or even went down, right? The sales are still going up, and they were able to increase production. I think the sleep apnea, and they're also testing it for osteoarthritis of the knee. I think these are just ways that they're trying to get insurers to cover the drugs that, because their insurers aren't necessarily, and certainly Medicare isn't, paying for it for weight loss as the just because you want to lose weight. But if you're obese and you have osteoarthritis of the knee, now obviously if you lose weight, you're going to end up with your symptoms for your osteoarthritis of your knee is going to improve, and your sleep apnea, if you have sleep apnea, your sleep apnea is going to improve, and then they're going around the insurance companies, which I think is smart, as long as the insurance companies play ball and don't still are willing to pay for it. And I think, probably they will, because it keeps it should save the insurance companies money on not having to pay for those secondary diseases that are caused by the obesity. So I think, as long as it's priced right and it makes sense for the insurance company, they'll certainly be willing to cover the drugs for when they have these secondary problems. The patients have these secondary problems. So what do you think of the valuation? It's trading at 17.8 times sales. It feels very high right now, especially considering how much potential competition they could have in the obesity space. And the obesity is certainly driving much of the growth. Now, I mean, quarter over quarter, sales were up 44.7% in the most recent quarter. So, obviously plenty of growth there. And I think that justifies the 17.8. But, the question is, can they keep it at 40, in the 40% range, or is it going to drop into the 20% range? And what's that going to do to the valuation?
Yeah, I do agree that the valuation is a little bit steep, especially from a price to earnings perspective, which I think is around 75 right now. Something I've talked about a lot is, if there's a stock that I really love and I'm looking at holding it for a really long time, a high valuation isn't going to keep me away, because my particular investment horizon is pretty long in duration. I do think you've seen so much enthusiastic about this company over the last year that's really baked into the stock price. I wouldn't necessarily expect, that kind of performance in the next year or two to replicate itself. But that was also why, looking at the company's growth opportunity, I'm mentioning some of these other drugs that they have already in their portfolio, some of which have, patent exclusivity dates that extend well into the 2030s. But these other newer ones like Omvo and Kisunla, I think could be really important for Eli Lilly, especially Kisunla for early symptomatic Alzheimer's disease. That one, I think, is a real disruptor, because there haven't really been a lot of drugs of its kind approved. So I think GLP-1 drugs have been a major tailwind for this business, but I don't think they're the only one. And even if, and this is just my personal opinion, but even if its growth was to drop, say, into the 30s or 20s, that's still significantly above the average growth rates you see from a pharma company, right? So many
Definitely.
times these these are really mature businesses, right? I mean, Eli Lilly
Yeah.
has been around since 1876.
Right. Usually, if you can get into double digits, low
You're
double digits,
good.
you're pretty happy. I mean,
Right.
that's a decent growth rate for a pharmaceutical company. So yeah,
Oh
I
yeah.
agree with you. 20-30% is still fine.
Yeah.
The other thing is they have an oral GLP-1 that's in phase
Yeah.
3 development. I think that's supposed to read out this year. So if the tolerability of that one is good, that helps them with all the competition coming up.
Yeah, I think that's definitely the case, and it's interesting as well because there was a question on Viking Therapeutics that had come in, and this is obviously a company that's also, I think, most people are watching them for the GLP-1 drug that they're working on, and specifically because it's being tested in both, an injectable as well as an oral formulation, and there seems to be a lot of interest around that company in particular.
Yeah, so AJ says that Vertex is up a lot today. It's up 14.7% right now, and it jumped like midday. And so I quickly jumped on X to look, and it sounds like there's a there's a Betaville article that says Pfizer's interested in buying Viking Therapeutics, so that's the reason why it's up so much today.
Ah,
So and then Pfizer's actually up too. So obviously investors are
I
thinking,
hadn't
oh,
seen
well,
that yet.
Pfizer's going to buy them. That's probably a good sign because Pfizer's been having problems with their growth rate. So, I don't know. That's what it is. I wouldn't buy it based on the fact that it might get taken out, but it has looked reasonably priced over the last few. Now I'm talking back to Viking. Viking Therapeutics has looked pretty promising in terms of valuation. It's at a market cap of $4 billion. So, certainly before, it had been much higher and then it dropped back quite a bit as it was taking a little bit longer than investors had been hoping for them to start their phase 3 clinical trial. They don't expect to start it now until the second quarter, even though they read out phase 2 data last year. So I think investors were sort of expecting the first quarter, a first quarter launch of the phase 3 clinical trial. But obviously, if they can get taken out, maybe they get moved. Maybe Pfizer can move faster than Viking can as a smaller company.
Yeah, this is actually really interesting to me. I talk about Pfizer a lot on this show. This is a company I have followed really closely for a long time. And I have really been stressing that, in my opinion, I think they're in a real period of transition, but that they are really well positioned for growth from the stream of acquisitions that they made from the billions in cash and profits they brought in, from their COVID-19 products. Obviously, the Segan acquisition, which I think was about $43 billion, added, I think, 16 new candidates to their oncology portfolio as part of their overall strategy to have 8 oncology blockbusters in their portfolio by the early 2030s, and effectively, doubled their overall pipeline. And that's just one. I mean, Nurtec, which they acquired from Biohaven, was another, blockbuster product. But something that also stuck out to me is, even looking at their recent financial report for 2024, the company's profitable. And even if you excluded their COVID-19 products, which again, lagging sales there have really weighed on results, they still grew, 12% year over year in 2024, their revenue. And prior to the pandemic, they were reporting single digit revenue growth at best. So you're looking at a situation where, yeah, they're working to get back, I think, into a very different and new era of growth post-pandemic, leveraging both their internal R&D as well as all the business development that they've done over the last few years. They're going to be dealing with increased competition in the generics market, especially heading into the 2030s, and all of these factors, I think, have been well planned for. I think that they are really well positioned with some of their recent product launches to start seeing a real shift, especially as we get late into this decade and early into the next one. And so the idea that they would expand into the GLP-1 market, because again, that's the candidate that people have been most focused on, and that I think Viking Therapeutics has trained so much of its focus on, that seems pretty logical. I mean, management had indicated they were not necessarily looking to do a whole lot of M&A soon, but this could make sense for them. I'm curious to see how this actually turns out.
Yeah, I guess we'll probably have to wait till Monday, right? If it's going to get announced, it's probably going to get announced on Monday morning, right? So if it's not,
Probably.
if it doesn't come on Monday morning, you'll see you'll see Viking start pulling back, I would imagine. Yeah, I mean, I think the loss of sales for Pfizer's blockbusters that are going off patent in the coming years have already been priced into the stock,
Yeah, I
right?
think so.
We already know that growth is going to not come, and you can just see it in the dividend yield, which is 6.6%. So basically, you're kind of getting paid right now, slightly under market market return, expected market returns for, just with the dividend alone, because you shouldn't really expect very much from the stock necessarily
Mm.
over the next, few years. You got to wait for these pipelines drugs that they've acquired to start working into the into the growth process to cover for those lost sales in the coming years.
Yeah, no, I think that's fair. We had a question that came in from Fool fan STL, getting back to the idea of earnings. Do you have knowledge on Guardant Health? And if so, have you been able to look at earnings? I don't know if this is a company you follow, Brian. It's one I follow a bit.
Yeah, I mean, I know they're a testing company, but I don't follow them that closely. Not as closely as you do. I heard you ramble on about them and Exact Sciences maybe 2 days ago. I was at the end of it was at the end of your hour and the beginning
Uh-huh.
of my hour, right before the beginning of my hour. So I was in the backstage
Oh, that sounds
listening to
right.
you.
Yeah.
Yeah.
Yeah, no, and I won't go too deep into that again, but they're definitely doing better than some of these other diagnostics businesses that we, talk about. You think of companies like 23andMe that have just struggled so much in the last few years from a lot of different headwinds. But Guardant Health, they have their precision oncology tests like Guardant 360, Tissue Next, and Reveal. And that's really the core of their business. Most of their revenue comes from clinical tests to diagnose and monitor cancer in patients. And they did report, yesterday they reported for Q4 and their full year 2024. So their revenue was about 739 million for the full year. That was a 31% year over year increase. Their oncology clinical tests were up 20% year over year. And then the biopharma test they facilitated up 35% year over year. A couple things, and I mentioned this, that have, kind of kept me away from being a shareholder in this business. I do think that they have a real continued market opportunity and footprint with their Shield screening tests, which is what they're well known for. But they're still burning free cash flow. They are, not currently profitable. They reported a net loss of about 111 million in Q4 alone, which is something that I don't like to see. It makes sense for where this business is at. But these are reasons that would keep me kind of away from the stock right now. I do think there's still a real opportunity for them, within the diagnostics market. They reported a full year net loss of about 436 million. And again, that was compared to revenue of about 739 million. So there's just a little update on the earnings there. I think that this is an interesting little company, but it's burning of free cash flow and continued unprofitability is keeping me on the sidelines for now. But I continue to follow it from afar to monitor how its finances continue to develop.
Yeah, I mean, I think that the biopharma business is the one that you want to look at the most because those sales are going to drive the retail sales in the future, right? So those are tests that they're running for biopharma in clinical trials. So if those
Right.
drugs get approved, then now they're going to become the standard of care for the test that tells the doctor whether to use those drugs. So if they get approved, then that's going to drive sales of the thing. So as long as those keep coming in, I think that's a sign, good long-term sign for a healthy business growth because I mean, obviously some of the drugs are going to fail and they're not going to end up resulting in retail sales. But I think, enough of them probably will that they're likely to result in sales in the future.
Yeah, it's a fast growing part of their business, but still a smaller part of their business. So it's one I'm
Right.
watching, but I agree with you. It could be
Yeah.
if adoption is significant enough there, I think that could be a needle mover for their cash and profit burn.
Yeah. Yeah. And I mean, obviously, like it's never going to be a large part of their business because there's always going to be ones that are going off of, they're no longer, the clinical trial is no longer being run.
Right.
So therefore they lose those sales and then they bring in sales from the other, and the new sales. So those are just going to like, they're just going to cancel each other out. Right. So it's going to be slow growth, but just as long as it's not going down, then I think that that's a good sign and it doesn't have to be a large percentage of their business. It's actually going to be the exact opposite. It's become a smaller and smaller portion of their business, hopefully, because those are going to end up getting approved and now they're not selling them to biopharma for clinical trials. They're selling them to doctors to do on their patients to figure out whether those drugs are appropriate for their patients.
Yeah, so it's really about broadening their potential customer base, especially because there's like a limited life cycle of use for each client, as you were mentioning.
Yeah.
We had a few questions that came in, but also some earnings you wanted to hit. So maybe if there's one or two of those, and then we can dive into some of these healthcare questions that have come in the second part of the hour here.
Yeah, I think Bridge Bio was probably the one that I was most excited about
Hmm.
this week. I put the list of everything, so if anybody wants any questions about them, Ionis seemed like they had a pretty good quarter. Bridge Bio they just got an approval in the end of November for a TTR drug for the heart version of TTR amyloidosis. So this is a TTR is a protein, and it comes as its stable form is a tetramer, so four proteins together, and when it becomes when those tetramers become monomers, they end up binding to each other in not how they're supposed to, and they end up creating these plaques, a whole bunch of proteins together, and they can either get lodged in the neurological system or in the heart. So this one's specific for the heart. It competes against Pfizer's drug. It's a multi-billion-dollar drug, and the way it works is it stabilizes the tetramer. So they obviously didn't have very much sales because it got approved at the end of November, and then they have just 1 month to report of sales. But they gave us prescriptions for Attruby, which is the name of the drug, from all the way through February 17th, and they said that they'd had 1,028 unique patients have prescriptions by 516 unique prescribers. And so that one, the number of prescribers is useful because if it's just one doctor, if a doctor's just prescribing it for one patient, they're just sort of, they're still in the trial phase of trying to see whether it works, or maybe maybe a patient, heard about it or something and comes in, and so they specifically want that drug. But they're at least at two patients on average per prescriber, and so that's a good sign because that means prescribers are comfortable with the drug, and at least some prescribers are prescribing it for more than one patient, and so that's obviously we'll have to see in the coming quarters, but it seems like it's off to a fairly solid launch considering we're only about 3 months into the launch.
Yeah, that's not a company that I follow super closely, but I'm gonna have to look into it a bit more. That sounds like a pretty promising report, considering they're really in the early stages post launch.
Yeah.
I was looking through here. There was a question on HCA. I don't know if you follow HCA Healthcare. But I follow this one a bit. And the question was from Besties. Any one of you have comments on HCA? What are your expectations for the next 5 years for this stock and business? So for anyone who doesn't know this company, they're basically a network of hospitals, emergency care, inpatient, outpatient facilities across the country. I believe they also have a few locations that are not within the US, but most of them are US based. And so their primary revenue source is inpatient, outpatient, and emergency care. They also offer services including surgical procedures, diagnostic services, specialized treatments. They obviously make money from arrangements with private insurers and managed care contracts. And then they also, of course, partner with government programs like Medicare and Medicaid. And then there's also various ancillary services that are part of the HCA healthcare network. So, imaging, lab services, pharmacy operations, really the full spectrum of needs that patients have. They reported their 2024 results actually at the end of January. I haven't had a chance to delve too deeply into them, but their Q4 revenue was about 18 billion. That was with net income totaling about 1.4 billion. Cash flow from operating activities was about 2.6 billion. Now, looking at the full year, they delivered total revenue of about 71 billion compared to about 65 billion in 2023. Their net income for the 12-month period also increased from about 5.2 billion a year ago to roughly 5.8 billion in 2024. And this is one of those companies that has been really good about maintaining a solid balance sheet and really robust cash flows. They finished out the year with about 2 billion in cash and cash equivalents. They also announced their quarterly cash dividend. This is a long-standing dividend payer. I can't remember off the top of my head the exact yield of the dividend for the stock. It's a little bit less than 1%. The stock itself has been a pretty modest performer. It's up about single digits from the beginning of the year. And I think that there are, concerns about companies within this industry, whether it's, there's obviously a lot of opportunity for a business like this. They're a for-profit operator of healthcare facilities. They have a massive and dominant market footprint within the US. I think a lot of investors are a little bit unsure about how to approach some of these companies with exposure to the insurance space right now. I think as there's a lot of continued uncertainty regarding regulation. I was talking a bit in the last hour about the news that a probe had been opened into UnitedHealth Group by the DOJ. So I think there's just a lot of uncertainty in the space, but this company itself has been and continues to be a pretty solid business. They've been around for, I think, more than 50 years at this point. And they are, the largest network of hospitals, one of the largest within the U.S. So a pretty good business and a pretty good year and report. So nothing too notable that stuck out to me with that one.
They've grown a lot through acquisitions, right? And
Yeah, acquisitions have definitely been a huge part of their strategy through the years. I mean, their own internal expansion, but yeah, acquisitions have been big, buying up a lot of these smaller centers and networks, which I think has worked, really well for them.
yeah, I mean, you can obviously they can if they can get better margins than the old operator, right? Then it's a win-win. The company gets, whoever the old owner was feels like they got a good deal, and also HCA feels like they got a good deal because because they're able to improve the margins and therefore end up getting more, free cash flow from the same revenue. And obviously, they can potentially grow the revenue because they have more experience. So.
Yeah, absolutely. I don't know if there's a question in there you wanted to grab.
Yeah, maybe just grab the quick one from David. He notes that we both like Pfizer,
Hmm.
and we've said that, I guess we've said that multiple times
We like
on
it.
different and on previous episodes as well. And so the question is it a value trap at the current valuation? And then also, do we think the dividend will be able to, they'll be able to continue to pay the dividend? Because I think that's really the key, right? If they're not able to pay the dividend, or they cut the dividend, even slightly, then it becomes a value. And then it actually, was a value trap because they're gonna have, I think a lot of it right now is that it's not going to fall any further than that because the dividend is the yield is at 6.6%, right? If it goes down further than that, increases the dividend yield and it makes people want to buy it even more. And so that's sort of putting a floor on the dividend is putting a floor on the low side for how much it could fall. And so I think that, as long as they can pay the dividend, there's less risk, right? So the dividend, the payout ratio right now is at 88.8%, and that's been pretty constant over the last few years, right around that range. So I think that gives them plenty of cash, and and it still allows them to have some cash that can go into their coffers and therefore pay for future revenue growth through acquisitions and licensing deals that they have to pay off. So I think, at 88.8% seems reasonable to me. And so I'm not very concerned with them lowering the dividend. I don't think they may not raise it in the current environment, but I don't think they're going to lower it.
Yeah, I think that's true. They've had a really good track record of maintaining and also over time raising their dividend.
They did cut it after they did the big Wyeth acquisition.
Right.
So they did cut it once, I think maybe in half or something like that. And then again, that was another time when it was trading at a dividend yield at around this, around 6.6.
Yeah.
And then obviously they needed the cash to pay for the acquisition and to service the debt from the acquisition. And so therefore, they made the decision to cut the dividend. And I think maybe the shares fell some when they did that. But eventually, like if you bought, right around then, I think you have a pretty nice return, at least, if you back out the last year or something, it was probably a nice return that may probably beat the S&P 500 from the lows.
Yeah, no, and then they don't raise their dividend every year. Some of these healthcare companies that are dividend payers do, but they have been, as you mentioned, pretty consistent. And I think that their upcoming dividend will be something like their 345th or 346th consecutive quarterly dividend that they've paid. So it's been a pretty steady pair in that area, and they do have a lot of cash on their balance sheet as well. And their earnings are looking increasingly in solid shape. So I agree. I do think that while the payout ratio is high, I do think they're well positioned to keep maintaining that dividend. And I think that's why a lot of investors are interested in the business right now, because the stock has not always been a high performer. I mean, we know how shares responded during some of the peak of the pandemic, given Pfizer's successes with its COVID-19 products, and of course the vaccine it developed with BioNTech. But the actual share price has never gone much above, $50 a share. It's not been one of those, blistering prices like you see, for example, with a company like Eli Lilly. So kind of just something that's interesting to note. There was a question, Kenvue is a spinoff from J&J. Do spinoffs usually do great? I've read that they do, but why then would they be spun off when they could continue generating dollars? Well, I think it depends on the company, but this is a good example. With Kenvue, this was the well-known consumer goods division of J&J that's known for the products like Band-Aid and Listerine and all of these other household brands, and that had been, while it was the oldest consumer goods business in the U.S. or one of them, and an incredibly well known and recognized family of brands within that business segment, it was a much slower growing business compared to Johnson & Johnson's pharmaceutical business, their medical device division, which they have really reoriented their focus on the last few years, especially with the acquisition of Abiomed, which is known for their Impella heart pump. So with Kenvue, I mean, that made a lot of sense for them. This was a slower growing part of their business. They were reorganizing the structure, and Kenvue has done, pretty well on its own. But Johnson & Johnson, I think, has been able to really focus on, the core parts of its business in the modern era, which are its pharmaceutical and medical device segments. And those are both growing at a really, steady clip. Another example, actually, to go back to Pfizer, is Upjohn. They had a consumer health segment that was really slow growing and was really weighing on growth. That was part of the reason why prior to the COVID era, they were delivering much more moderated growth than they had in prior years, because that segment was weighing down so much. So, spinoffs don't always do great, but often they're a great decision for the company that spun them off. And then you've got examples of some of these businesses, that it's been a success for. I think Zoetis is another example. I don't know if you have thoughts on that.
Yeah, no, I think, I thought I was going to mention Zoetis. I think Zoetis has probably done well. The at least so far, Kenvue has not. It's down 13.8% since the spinoff, compared to Johnson & Johnson, which is basically flat for the same time frame since I guess the first half of 2023 is when the spinoff happened. And then just to mention Pfizer, that's actually the second time Pfizer has spun off sold its consumer health business. So it actually sold its first consumer health business to Johnson & Johnson, and then got one in the Wyeth acquisition, and then decided they didn't want it again.
We don't want this either. Yeah,
we don't want this one either. And so they partnered with GlaxoSmithKline to create a joint venture. And that makes sense because, these are low margin businesses. So anything that you can do in terms of increases in volume, I think is helpful in terms of sharing fixed costs. So I don't know. I think they were going to spin that out as an IPO. Glaxo owns more of it, so it was like Glaxo's decision. But I think they were planning on spinning it out, and then Pfizer was going to own shares, and then eventually be able to sell it. But I don't remember the time frame for when if that's already happened, or if it's in the process still.
So Upjohn specifically was, that was quite a story for this particular business through the years. But they merged with Mylan, I think.
Right? So that was a generic drug business, not a consumer. Upjohn was consumer health, but Pfizer did with their Advil and the products that they got from Wyeth. Those went to GSK. So we're talking about two different businesses. The Upjohn was generic business that went to Mylan, and then that's a new name. They changed the name, I think, of that company, right?
Yeah, I think now it's right. Yeah, it's Viator. Looking at
Yeah. Okay. So according to Google, the Pfizer.
Sorry,
sorry. I think one of us was not working.
One of us went out.
I realized I was talking over you, so I just stopped and we could do it. So according to Google,
you're fine. Go ahead.
Yeah. So according to Google, the Pfizer GSK one ended up becoming Haleon, which then went public in 2023. So I think it might trade on one of the European stock exchanges, not the US one, if I'm remembering correctly. But that's the story on the consumer health business, and then the Upjohn was the generic drug business that ended up going to Mylan.
Yeah, because they had this, as you mentioned, this consumer health division that was then sold off, and then the remaining part, which was the pharmaceutical business that sold, prescription medicines, complex generics, biosimilars, then merged with Mylan to form Viatris. It's a very complicated web, but that I think was a good move for Pfizer. I have not checked in on the status of how Viatris has been doing.
Yeah,
the last. Looking through here, Ed was asking, do healthcare stocks do better than tech stocks in a market downturn? I think it depends. I think that looking back, over the last several years, broadly speaking, healthcare businesses from a business standpoint tend to be more resilient in periods of downturn, both economic downturns. Now, sometimes you've got companies like, Johnson & Johnson's a great example. This is one of those legacy businesses that's incredibly mature and is, not delivering really exponential growth at a business level. And so I think it's more of an income investment play. That's why I am a shareholder in the stock. But I do think often you tend to see these tech stocks experience much more volatile and notable dips and movements in a market downturn. It obviously depends on the company. But I think it's one of those things where often they're more reactive stocks. They're much higher growth stocks. There's often a much bigger reaction to news with these types of businesses than you see with healthcare stocks. But I think it really depends. Sometimes we've seen this in prior bear markets where stocks across all industries, including healthcare, are hit. Now, putting share price movements aside for a minute, right? How are these stocks actually performing? Why does a market downturn happen? Well, sometimes a market downturn happens because there's actually, economic factors at play that impact investor sentiment. There's a lot of reasons for these downturns. In a period of, macroeconomic difficulty, I think a lot of consumers and investors are still concerned about what the state of the global economy will look like in the next year or so. You do tend to see that healthcare businesses and the importance of investing in businesses and not just share prices is key here. Healthcare businesses tend to remain really resilient because, people need their medicines, they need their vaccines, regardless of what's happening, with the stock market or the economy. So I think I have always gravitated towards these businesses because while share prices might dip if the whole market's going down, the businesses tend to be primed for a more, I think, robust recovery sometimes than some of these other higher growth businesses we see that I also like to invest in. Well, I don't know if you have thoughts on that, Brian.
Yeah, I have two thoughts. One, I think it also somewhat depends on the drug and the disease that they're treating. So
Right.
something like obesity, we might see a dip in if the economy if we let's say we enter a recession. We're going to enter a recession at some point in the future, right? We'll just make that assumption based on history. So when we enter a recession in the future, you could imagine that obesity drugs might take a bigger hit than heart drugs, right? Because people may not want to go into people may lose their insurance and not go into the doctor because and that who might have gone in for an obesity drug might still go in for a heart drug, and so I think that's one thought. The other thing is biotechs that don't have drugs on the market, they're being valued on their future potential revenue, right? And so when we have a recession, typically interest rates go down, and then therefore the risk-free return goes down, and therefore the value of biotech companies, potential for biotech companies that don't have drugs on the market, so they're being valued at their future sales. Those that's that price is fixed, right? It is what it is. They're gonna, you've decided that the drug has a potential to have, $1 billion in sales in 5 years. So when you backtrack it to the current valuation, if the risk-free return is lower, now that becomes more attractive. Taking on that risk becomes more attractive, where when you can get 5% risk-free return, then that therefore doesn't become as attractive to take on that risk. So because it's more attractive, the valuations tend to go up a little bit. So two ways to think about potential for a recession in the future.
Yeah, I think that's right. We also had a question about CRISPR Therapeutics. The stock hasn't performed so well. Is the company better than the stock? The only therapy they have approved right now, although they have a really interesting pipeline that I continue to follow, is Cascavy, which they developed in partnership with Vertex. And Vertex for me has been a company that I've been much more bullish on because they already had an established and profitable business from their cohort of cystic fibrosis therapies. These drugs, they're called CFTR modulators. They are the only approved drugs currently that treat the underlying genetic causes of cystic fibrosis. And so when I was looking at, an opportunity to benefit from the growth of this space, and just based on my own risk tolerance level, I've always been a bit more drawn to a company like Vertex. Now, CRISPR Therapeutics does have a number of intriguing clinical programs in development that I think are worth watching. They're developing a couple different in vivo gene editing therapies, right, for cardiovascular disease. They're also working on therapies that could target other therapeutic areas, including autoimmune diseases. And they're even looking into therapies that would involve, gene editing of stem cells to treat diseases like Parkinson's and Alzheimer's. Any type of commercialization would seem to be very much in the future, years from now. And as we talked about earlier in the hour, even when a CRISPR therapy is approved, which there's only been a few that have so far, the process of actually getting it to the patient and administering it and ensuring adoption of it is such a multi-pronged process. It's not the same way as distribution and launch of a traditional pharmaceutical drug. I don't know if CRISPR Therapeutics is one that you follow, Brian.
Yeah, no, I mean, I do follow it, but I haven't looked at it recently. So I was trying to figure out when their next sort of readouts are, because that's, their website is not that great. It just lists clinical. It doesn't tell you like what stage the different drugs are in.
Right.
And so it's, it's really like, so I was going to the presentation, the Q4 presentation, to see if I could figure out when what their readouts are for this coming year, to see. But yeah, I mean, I think let's see, here we go. Looks like they're going to get an update for a CAR T for which is for solid tumors and blood cancers. Or I guess the solid tumor one is going to read out in 2025, and the blood cancer is still ongoing. And then they've got 1, 2, 3, 4 different readouts for their in vivo treatments in 2025 So, but I don't. Again, it doesn't say what stage
what stage are we in,
clinical
right?
trials are at. So, I think you'd probably, I mean, eventually, you could. If we did a little more. We had more time and did a little more research, we could certainly figure it out. But I think that means they're probably not phase 3, right? So
Yeah.
we've got some time before they're going to have another drug on the market. And the other thing to note is that they don't even have 50% of the sales for Casgevy, right? They have, I think, 40%. So, that potentially doesn't help them. And then of course it's losing. I don't think the business is profitable yet, right? Because first of all, it takes about 6 months between when a patient decides they want to go on the to get the therapy to actually, getting the therapy, right? So I think that's a potential problem there.
Yeah, agreed. Well, that was a very fast hour, Brian.
It was.
Thank you for all your insights. It's been fun. I look forward to doing it again soon.
All right. Hey, Danny, you're back.
He's back.
Brian, how are you?
Good.
It's like deja vu all over again.
Yeah.
I know. We just did this.
All right. See you guys later.
Thank you.
See you, Brian.
All right, fools. Well, it's my final hour of the day here on Fool24, and I'm joined again by Danny. Great to have you back with me, Danny. How are you doing?
I am doing just as well as I was doing a couple hours ago. I
So glad.
still have my green and black Hawaiian shirt on, so plenty of color for the the non-monochromed among us.
Mm-hmm. Love it. Love it. So for this hour, we're going to be talking about building a diversified portfolio, right? And this is something we talk about a lot here at the Motley Fool, this concept of, working towards building a portfolio of at least 25 or more stocks diversified across different industries and sectors, which, offers I think, a whole host of benefits. The ability to capitalize on the growth trajectories of different industries and companies is one, right? Not having, overt portfolio exposure that is excessive to any one company or industry can also be really beneficial in periods of downturn, because not all companies and industries perform the same, right? So investing in a mixture of cyclical as well as non-cyclical businesses, ones that are more resilient in times of changing consumer habits than others, I think can enable investors, and this is something I found with my own portfolio, to really benefit from a wide range of growth factors in different environments. And it's also just exciting, I think, as an investor, to be able to have the opportunity to become, part owner in such an array of different businesses. I think most of us all have a wide range of interests. And one of the benefits I love about investing is that I can invest in companies that I find interesting, maybe that I'm, a customer of. And then I also find that I want to have, a portion of that business in my portfolio as I build it out. So these are some of the things that I think about as I build out and diversify my portfolio. But, Danny, I know you're a much more experienced investor than I am, so I'm very curious to hear your thoughts.
Well, to be honest, I am an anomaly. When I first started investing, I didn't really pay much attention to building a diversified portfolio for the sake of building a diversified portfolio. I merely bought the stocks that I thought would do well, regardless of what industry they were in. Now, I have over time gravitated towards technology, but I did want to share a definition that I came across that I think could be helpful in the discussions. So portfolio diversification can include a mix of stocks, bonds, potentially alternative investments, but you want them across various sectors, company sizes, and geographic regions. And the right asset allocation depends on your individual risk tolerance, time horizons, and financial goals. And what that tells me is that there is no magic bullet. There is no one size fits all. There's no one diversification model that would be perfect for every investor. Now, I did, in preparation for the show, I did go look at my diversification. And again, my portfolio is largely technology. But I do have some diversification across geography. So I've got about 10% of my portfolio is in Latin American stocks, one in particular. I have a couple of stocks that hail to us from Canada. I also am broken out across industries. For instance, I was surprised to find that I have about 5.5% of my portfolio is in restaurant stocks, which you and I have talked about on and off. So there is more than one way to diversify. And I think, even the fact that my portfolio is tech heavy, if you look at my top positions, Netflix, okay, well, that's streaming video and it's consumer facing. NVIDIA, that is consumer facing, but also it's business facing because of its AI implications. Mercado Libre, both consumer and business facing. Apple, largely consumer facing. Shopify, mostly business facing, but businesses that are they're serving businesses that are consumer facing. So, there is a mix there within the broad umbrella of tech with business facing, consumer facing, mega tech, big tech, smaller tech. I've got mega cap restaurants like Starbucks and Chipotle, but then I also have tinier stocks like Portillo's, ticker PTLO, Dutch Brothers, ticker BROS, and Toast, ticker TOST, that kind of round out that restaurant segment.
Yeah, it's been fun as I was looking at kind of the breakdown of my investment portfolio. A lot of it is really revolving around different subsectors of healthcare and tech. So on the healthcare side, pharmaceutical businesses, medical device stocks, telehealth businesses, right? And then, on the tech side, you've got your classic, consumer facing businesses, software as a service. I'm obviously a newer investor in the sense that I really started my journey about 5 years ago. But I do think the exciting thing is that, diversification is not a one time thing, right? As we build our portfolio through the years, different stocks are going to perform differently. And that can, in turn, affect the different weightings a company has in your individual portfolio, right? Because not all companies are going to perform the same. And so revisiting the balance of a portfolio and, checking to make sure that that balance aligns still with, you know, my preferred risk tolerance and where my goals are at, both for the short and long term, is something that I also keep in mind. And so, diversification has been something that I've been working on regularly through the years, not just in buying more stocks, but continuing to keep an eye on how that breaks down to actually the different weightings in my personal portfolio.
Yeah, and I think that that goes right back to what you were talking about earlier, which is that it kind of evolves over time. Some of the things that drive different parts of your portfolio. It's interesting when I look at my portfolio. Netflix has long been my largest holding, but my top 5 or 6 positions have switched places quite a lot over the
Mm.
past couple of years. Mercado Libre is my third largest position, ticker MELI, but it was passed up over the past year by NVIDIA, ticker NVDA. I've still got Apple, ticker AAPL, Shopify, ticker SHOP, and Amazon, AMZN, all in the top 5 or 6 positions. But it wasn't always there, so it changes dramatically over time. And yeah, that's why I don't spend a lot of my brain power trying to make sure that I have some kind of a theoretical optimal diversified portfolio. Now, one thing that I do that I think is that I personally think is important is that particularly as I am several years away from retirement, and since there is still the potential over the next 3 to 5 years for a significant downturn in the market, I have an emergency fund that has about 6 months worth of spending socked away. I also have, if I look into my portfolio, I've got about 3% of my portfolio in cash. If I were to add that to the money that I have put away in savings and CDs, I think I could easily live for 12 to 18 months without having to ever touch my stocks. And I think that gives me a lot of comfort, knowing that even if there's a market downturn and it happens within a short time before I retire, I have resources in different buckets in such a way so that I don't have to worry about it. We're not going to have to eat cat food if the market decides to take a plunge the day before I retire.
Thanks for that, Danny. We had a question that came in from Sadaf, was asking, what is the trigger for today's sell-off? So I thought maybe we should talk a little bit about what we're seeing in the markets today. I think that's a question. And I'll, kind of start off with some of what's happening, right now. we've seen that the Dow slipped about 600 points so far today. Obviously, we've still got a few hours left in the trading day. The NASDAQ has been down by more than 1% today. The S&P 500 also trading down by about 1.4%. And I think that there continues to be a situation where you're looking at these market movements. And I think this is a lot of fear-driven actions, by investors. There's also a few companies that are having a big impact on the movements of the market right now. So, for example, UnitedHealth, which I talked about earlier today, and the report from the Wall Street Journal that allegedly the insurer is under investigation by the Justice Department. UnitedHealth shares at the time of that news, I haven't checked to see how shares are doing now, dropped 7%. That had a major impact on the broader performance of the Dow today. There was also some reporting that came out from the University of Michigan that the Consumer Sentiment Index fell to 64.7 in January, which was a 10% decline, a steeper drop than expected. What does that tell us? That tells us that consumers are worrying about inflation. There's worrying that there might be higher inflation ahead. This was a 5-year inflation, the 5-year inflation outlook part of the survey was 3.5%, which was the highest actually that index had reported since listing home sales in the U.S. Fell a little bit more than expected in the month of January. And there was also, a benchmark 10-year Treasury note yield dropped about 8 basis points, which pushed prices higher. And the Japanese yen also was gaining some ground against the U.S. dollar. So Walmart is another company that's had a big impact on the market in recent days. Shares of that stock have pulled back a bit after they delivered a weaker than expected outlook for the year, which was still fairly solid. Single-digit growth for a business of this size, despite the fact that they're forecasting slightly more modest growth. So broadly speaking, investors are worried about inflation. They're worried about what is going to be happening with the state of the U.S. economy. We're seeing a lot of different news that is constantly evolving, right, regarding the state of tariffs, regarding measures that could impact companies across a wide range of sectors, regarding changes in regulatory influences. There is a lot that investors are contending with right now. Now, the flip side is that some of the stocks that you're seeing do really well today are more defensive businesses, right? Procter and Gamble is an example of a stock that shares were actually up single digits in trading today, which again, this is a very moderate growth blue chip stock. You don't traditionally see a lot of movements with that stock. General Mills and Kraft Heinz were also moving by single digits today, seemingly showing that investors are gravitating towards more defensive businesses as they worry about the overall resilience of the economy. Now, what does that mean? Thinking about myself, speaking as a long-term investor, I think that it is important to understand that, while no one can predict, the state of the economy or the stock market moving forward in the coming months, none of us have an exactly clear view on what will happen. We do know that market downturns happen. We know that recessionary periods happen. They are inevitable, not only in the life cycle of the consumer, but in the trajectory of one's investing journey, right? And I think this is what you're seeing right now. I think there's a lot of fear in the markets. Now, as a long-term investor, for me, not only does that make me continue to gravitate towards building some of my positions in some of these more defensive businesses that I do own, including in healthcare, but I also then tend to look at companies that might be seeing share prices wane, not because there's actual issues with the underlying business, but just broadly because of consumer sentiment. And for me, that can present a period to buy on the dip. I think there's that quote about, be greedy when others are fearful. No, I don't think anyone's trying to undermine or dismiss some of the concerns that consumers have and investors have that are playing into the market. I think it's important to understand where some of those movements come from. But that doesn't mean that there aren't opportunities for businesses over the next 5 to 10 years for long-term investors. I think with the appropriate buy and hold horizon, now could be a great opportunity to take a look at a lot of stocks on my personal watch list. But I want to hear your thoughts, Danny, on what's going on in the markets today.
Well, a couple of things. To me, and mind you, this is with, benefit of hindsight, having done this for, almost a couple of decades now. Today, I went to look and see. I was like, oh, the market sold off today. I'm looking at
Right.
it. So combined, the three major indexes are either side of down about 1.5%. And again, I don't want to dismiss anyone's concerns, but I don't consider that a sell-off. If I remember, there have been days where the NASDAQ sold off 5% in a single day. That's a sell-off. The stock market tends to move. Stocks go up and stocks go down. And the stock market moving by 0.5% or 1% or 1.5% in a day is a fairly common occurrence. It happens all the time. Now, I think, like Rachel alluded to, there are a couple of things happening in the broader environment that may be causing a little uncertainty. What I learned early on is that Wall Street hates uncertainty. The market hates uncertainty. Investors hate uncertainty. I think one of the things that's weighing on the market today was that when Walmart reported its results, which were fine, Walmart said, we're going to give you somewhat conservative guidance because we think over the next couple of quarters, we're going to see consumer spending slow down. Consumer spending is the bedrock that our economy is built on. So if there is, in fact, end up being a slowdown in consumer spending over the next couple of quarters, then we could see economic weakness. I don't want to say a downturn, but we're already dealing with high inflation. Consumers have been spending briskly over the past couple of years, which has kept the economy afloat. Excuse me. We haven't had, we had that economic downturn that happened a couple of years ago. The market has been gradually coming back. We still haven't shaken off that higher inflation yet. So there is a potential for broader economic weakness. I think that's one of the things. And whenever you talk about consumer sentiment, that can also have a broader impact on on investing, because if I'm a consumer and I'm not sure that the market is going to do well in the near term, I might take some of that money and spend it on something instead of putting it into the stock market. And if there's less demand for stocks, then the stock market will go down because it's weaker. So I don't really think that this is much of a sell-off. If this continued for the next, few days or weeks, I might become a little more, I might pay a little bit more attention to it. But to be honest, I didn't even know the market was down today. I did know that a lot of the stocks I own were in the red. Mercado Libre wasn't, so I was happy about that. So yeah, I think going into Rachel's point about building a diversified portfolio, I looked through and most of my stocks are in the red. I did notice that I have a few very small positions in Chinese stocks. I have Baidu, which is ticker BIDU. I have a small position in that. I have a small position in Tencent Holdings, ticker TCEHY. I have a small position in JD.com, ticker JD. And surprisingly, Chinese stocks are up today, even though the market here in the US is down. So that's kind of another single data point that helps explain why diversification can be good.
I think that's the case. And it's also worth noting, Palantir is down about 5% today. And that has been impacting, the broader NASDAQ as well. That's had an impact on some of the movements you've seen there. On the flip side, I was talking a bit more about that defensive businesses earlier. While Danny was talking, to check some of the more defensive companies in my portfolio, like my healthcare stocks, which are all trading up by about single digits today. So it's interesting to see. We talk about how we don't make investment decisions based on, a short period of movement in the market or, a single financial report. And that is definitely the case. And, could we be in a more prolonged period of volatility in the market? I think it's way too soon to tell. We know some of the factors that are moving the market today, but when I'm looking at minimum 3-5 years investment in a stock, probably much more, in most cases, with the way I approach building my portfolio, even months of volatility aren't going to keep me out of the market.
So there's a couple of questions in the queue that I thought I could knock out really quickly. Bestie's asked about 16 minutes ago, Danny, would you sell some Palantir or the trade desk now? Again, we've talked about this before. I think both of those businesses are well run. I think they have a bright future ahead. And the only thing that I'm seeing is weakness in the stock prices. And I don't make decisions on buying or selling based on whether or not the stock price goes down. I have looked at the trade desk's results. They were good, but not fantastic. And recently, stocks that give just okay results and not fabulous results have been selling off, particularly if they have high valuations. Palantir and the trade desk both qualify in that regard. Palantir has been growing ridiculously. They were up, I want to say, something like 800% over 3 years, if I'm remembering correctly.
Yeah,
and it's the valuation, it was selling for, I don't know, 173 times next year's earnings or something. So no, the company continues to do well. They have a great future ahead of them. They have a broad total addressable market. I never sell stocks based on the stock price falling. I make those decisions based on the underlying business. Matt asked about 13 minutes ago, Danny, are there Portillo's locations near you in San Diego? Funny you should mention that. There are not. The closest one from me is about an hour and a half away, and it's up near Disneyland. But my wife and I make occasional pilgrimages to Disneyland, and I try to make it a point that we swing by there either on the way to Disneyland or on the way back from Disneyland, so that I can eat some of my favorite Chicago dogs. And, this is a company we've talked about a lot. I won't belabor the point, but I also think the fact that they are growing well, not fantastic, but given the tough economic environment and the difficulty restaurants are seeing in same-store sales growth, I don't see any problems with my investment in Portillo's right now. Now, Bestie's also asked, and this I think we can probably both address, said, let's see here. No personal advice, but you said you allocate about 18 months of cash. Do you think that's enough? Market downturn could last several years, no? That's a good point. For most of my investing career and my work life, I had at least 6 to 12 months worth of expenses socked away either in savings accounts or in CDs. Now, when I'm talking about what I'm looking ahead to is when I retire. And I want to make sure that there's enough money there that if I go into retirement and if there's a downturn, I don't end up in a situation where I can't meet my financial obligations. Now, The reason why we say that everybody's situation is different, I'll just give you a little bit of mine. I have 4 different investing portfolios. I've got my taxable account, or my WAM account, which is my walking away money. I have a simple, I have a Roth, and I have a rollover account. I also have, I will be able to access Social Security in a few years, not yet, but in a few years. My wife will have access to Social Security. And then also, my wife has a pension from one of her previous employers. So, with all of our different buckets that we have money to draw from, I have 18 months worth of expenses. But if I needed to, and I wanted to, take money out of, say, my Roth, that gives me another couple of months worth of expenses, and there's no tax implications for the Roth. And if I needed to, get a little bit further, like I said, between savings, between the cash that I have in my investing account, and between all the other assets and the places from which I can draw funds, even if a downturn lasted a couple of years, I'm in a position where that's not a worry for me. If I was not as close to retirement, this would be even less of an issue for me, because both my wife and I have worked for the entirety of our adult lives, and the fact that I was working, if my wife lost her job, or if I lost my job, the other one was working. And that meant that there was even less that we had to cover in terms of expenses, because one of the pair of us was still working. So really, I think there are a lot of things that investors need to consider in their own personal situation. But for me, yeah, I think 18 months worth of cash is enough.
Yeah. No, I think that's right. And obviously, I'm much further away from retirement, and I have, despite that, continued to be quite conservative with how I allocate money into a nest egg. I think I generally try to do somewhere around 18 months, maybe a bit more. And it's also something that I regularly might add a little bit to here or there to make sure that it's at my preferred level, based on what else is happening just in the world, and with the economy and what factors I see at play there. And that's money that I would never ever touch or put in my portfolio for investing in stocks, for example. I keep that completely separate from my investing capital. And I would say, though, generally speaking, the amount and the period in which that would fund my life has shifted in terms of how much I set aside through the years. And that has just changed as I've gotten older and as my personal obligations have shifted. So it really is a very personal approach, I think. There were a couple questions I wanted to hit as well. There was one that came in from Besties about 41 minutes ago about ticker MCK, which stands for McKesson. For anyone who's not familiar, this is a company within the healthcare space. They are primarily known for distributing pharmaceutical products and medical supplies. They also provide health information technology and care management tools. So one of their core aspects of their business model is they buy drugs from manufacturers and then sell them to pharmacies, hospitals, and other healthcare facilities for a profit. They also charge fees for services like logistics, inventory management, credit risk. They generate income from fees for their health information technology and information management systems. They are a major distributor of many of the pharmaceutical products that are actually consumed in North America. Their supply chain is really integral in helping move medications from manufacturers to pharmacies and hospitals. So their pharmaceutical distribution business is the core business, where, again, they're buying drugs from manufacturers, distributing them to healthcare providers, pharmacies, hospitals. They make money from the distribution of medical supplies. And then again, there is their software and analytics tools that they sell to healthcare providers to help manage their operations. So interesting business. It's actually one I really like. They are in the middle of their fiscal 2025. So they have not reported their full year report yet. They reported their Q3 of fiscal 2025 in early February. And just to give a few highlights on those figures, they delivered consolidated revenues of about $95 billion, which was an 18% year-over-year increase. Earnings per diluted share of $6.95, which was a $2.53 increase from 1 year ago. Now, in the first 9 months of the company's fiscal 2025, they delivered about $2 billion in net income, which was down slightly from 1 year ago, but still, worth noting that they are GAAP profitable. The first 9 months of the year, they also delivered revenue of about $269 billion, which was a 15% year-over-year increase. And then again, their third quarter revenues were $95 billion. So this is a massive business. That 18% year-over-year revenue growth on the top line was primarily driven by growth in their U.S. pharmaceutical segment, which I explained a moment ago. And this has been helped by increased prescription volumes. They've also been seeing higher volumes from their retail national account customers. And they're also seeing growth in their oncology business. The company is also working on selling a couple of its slower growing retail businesses right now. And they also recently signed a definitive agreement to acquire a controlling interest in a company called Prism Vision Holdings. So I like this business. I think that this is sort of a play on something we talked about yesterday, which is pick and shovels investing. This is a business that is its distribution network is integral in delivering medicines, vaccines, and other pharmaceutical products from manufacturers to healthcare providers and pharmacies all over the country. This is a profitable and high revenue producing business. So this is one I like, and I think I will be probably talking about their full year report when they release that in a couple months. And then we also had a question that I wanted to hit really quick, if I can find it. That came in from Rose 56 minutes ago. Where does Amgen rank as a biotech? So in terms of just, maybe I'll talk a bit about how the company is doing. They are considered a biotech business. They have a biopharmaceutical company. They're one of the world's largest independent biotech companies, and they do have a wide portfolio of profitable products. They focus on a range of different disease areas. They focus on oncology, hematology, inflammatory conditions. They also have a number of drugs that target issues, including bone health and various cardiovascular concerns. Some of the products that they're most known for are called Enbrel, Prolia, and Repatha. So Enbrel is an anti-inflammatory medication that's used to treat numerous ailments, including rheumatoid arthritis and psoriatic arthritis. Prolia, which is another one of the drugs I mentioned, is a monoclonal antibody. It prevents bone loss in individuals who have osteoporosis and bone metastases. Otezla is another top-selling drug in their portfolio. This is an oral medication for moderate to severe plaque psoriasis. They also have a drug called Blincyto that's a monoclonal antibody for acute lymphoblastic leukemia. So really broad and diversified portfolio. They actually released their earnings also for their full year in early February. I think I actually looked at their results a bit earlier in the month on one of the shows, but bottom line, it was a really solid year of growth for them. Their total revenues in 2024 increased to 19% year over year to $33 billion. Their product sales grew 19%. They had 10 products from their portfolio, including a number of the ones that I just mentioned, 10 products that delivered at least double-digit sales growth for the full year. And they had 21 of their approved products that achieved record sales for the full year. So really in solid shape there. There were a couple things that were worth noting. So for example, their GAAP earnings per share decreased double digits. This is I would expect to be a very short-term trend. The main reason there was they recently acquired a company called Horizon Therapeutics that weighed heavily on the bottom line to close out the year. I would expect some impact from that acquisition in the next few financial reports at least. But for anyone who notices that, that was the main driving factor there. They did generate about $10 billion of free cash flow in 2024, which was a nice bump from the $7 billion in free cash flow that they reported in 2023. And again, as I was mentioning, they have a really significant portfolio of drugs, both some of which are blockbusters already or are expected by analysts to achieve blockbuster status. And again, the fact that 10 of some of their top selling products delivered at least double-digit sales growth, that is a really excellent growth rate for a business of this level of maturity and with as diversified a portfolio as they have. And they also have a really impressive pipeline with therapies across the therapeutic areas that I mentioned. So I think this is a solid biotech stock. If you're looking at this space, there's a lot of these newer, riskier biotech companies I talk about a lot on the show, some of which don't even have revenue or approved products, which I follow but don't invest in myself. Companies like Amgen can be a really interesting way to, capitalize on the growth potential of the biotech space, but by doing so in a more established business.
So there's a few of them in here that I can knock out relatively quickly. I want to start with Miramar Beach Jim, who says, where do you put the money you set aside for a rainy day? So I have an online savings account where I put, just our everyday savings, but I also have a number of rolling 5-year CDs, many of which actually recently got updated when interest rates were at record highs. Now, the reason that I did that is because even if I need to close out those CDs before their term is over, and I lose a couple of months worth of interest, it will be still well worth it to have money in these CDs earning about 5% interest, which is what they are. So that's where I have money set aside for a rainy day. Foolist asks, are you not concerned about Portillo's debt? I am not concerned about Portillo's debt, but the reason for that is that this is a company that is growing quickly. They are expanding into new locations, and that is something that costs money. Now, I know that there are some companies who take a different approach, and they're only willing to expand based on, the cash flow that they have from their current operations. Portillo's, they have about $300 million in long-term debt, which I don't think is excessive. I went just to look and see, just to get a comparison. Yum Brands, which is a much bigger company, has about 11 billion in debt, and Starbucks has about 12 billion. So for its size, I think Portillo's debt is manageable. And let's see, the other question that I was going to answer was from Besties, who said, no specifics, but how much of your time-rated returns are higher or lower from your 2021 high? That will tell you how diversified you were. I don't think that's necessarily the case, but I'm happy to share that. I actually looked up my numbers. Now, this is going back to, I'll give you a little background here. I was previously with another brokerage house, which was acquired. And so my stock portfolio has been with Charles Schwab since that happened in 2017. Now, since then, I didn't think I had these numbers, but thankfully, Charles Schwab provided them for me. So my taxable account since then is 20% annualized. My rollover and Roth are 18% and 16% respectively. And my SEP account, which is much more, has much riskier stocks in it, is about 23% annualized. Now, I'll share those numbers with you because I actually have records going back to when I first started investing in 2007. And the thing that has served me best has been buying stocks and holding them for the long term. And some stocks that were given up for dead several times in the past have come roaring back. Netflix, ticker NFLX, and NVIDIA, ticker NVDA, are two of them. At one point, NVIDIA had lost more than 66% of its value, and this is within the past several years, and Netflix had lost about 80% of its value, and those stocks came back. Now, the reason that I point that out is because by committing to holding for the long term, you give these companies the opportunity to do what they do, even when Wall Street gets nervous, even when there are massive sell-offs. And so, I am happy with my results. I know that going back to 2007, when I started investing, I have an annualized return of about 20%. And that is not because I'm so smart as an investor. It isn't. It's because people that were smarter than me drummed it into my head early on, over and over again. Don't sell, don't sell, don't sell, unless there's a really good reason to. Now, as an accountant, I remember selling Green Mountain Coffee Roasters, which is Keurig, because there were investigations by the SEC and accounting red flags. I sold out of that stock. But, when Netflix came out and said, we're going to spin off our DVD by mail business, we're going to focus on streaming, and we're going to increase our prices, and the stock just took a tumble. It was down, like I said, over a period of several months, it was down 80%. I bought the stock, I held the stock, and I went, that doesn't change the investing thesis. My investing thesis was that they would be able to increase their penetration across the United States as they had done in their earliest markets. And when they decided that they were going to go worldwide, that cemented it for me. So I think there's a good reason to hang on to stocks because the results speak for themselves.
There were a couple questions I wanted to hit. We had one from Shrinking Horizon 8 minutes ago. Rachel, do you have any thoughts on ANVS, which is the ticker for Innovis Bio? So this is a very, very small business. This is not one I currently own. It is one I'm following a bit. So I'm happy to briefly offer my thoughts on that. So this is a pharmaceutical company. They're focused specifically on developing treatments for various neurodegenerative diseases, including Alzheimer's and Parkinson's. And essentially, their goal is to create drugs that can inhibit neurotoxic proteins and improve brain function, and therefore be effective treatments for these diseases. The drug candidate that bears the most watching for Innovis Bio, and I think the one that probably anyone who follows the stock is most focused on, is called butane tap. It's very hard to pronounce these names, but I think that's how you say it. It's a small molecule that targets multiple neurotoxic proteins. It's being studied as a potential treatment for Alzheimer's and Parkinson's disease. In early February, Innovis announced that it was actually dosing or entering the first patients for its pivotal phase 3 study of butane tap for early Alzheimer's disease. So just the first 2 patients at the time of that announcement had been entered into their phase 3 study. Obviously, that's a significant milestone for the business. This trial will be randomized, placebo-controlled and double-blind, obviously designed to study the safety and efficacy of butane tap in patients who have early Alzheimer's disease. It will be tested in a once daily dose. The treatment will last for 18 months for participants in the phase 3 study, and it will consist of 2 parts. There will be a 6-month assessment of the symptomatic effects of this drug candidate, and then there will be a 12-month evaluation of its potential disease-modifying effects as a treatment for individuals with early Alzheimer's. So that is what I'm watching most closely. Again, they had back in October, they had conducted their end of phase 2 meeting with the U.S. Food and Drug Administration. They had been in process of getting ready to start with phase 3 studies. So the most recent and most notable information we have is that they had entered their first participants in the study, the phase 3 study, as of early February of this year. So because they don't currently have approved products on the market, they have, some cash on their balance sheet from some existing agreements and warrants, but they are not a revenue producing company at this point. They closed out their most recent quarter with cash and cash equivalents of about 14 million. So something to be aware of with this business. Very, very early stage, and their most promising therapy at this point, and the most progressed that I'm aware of, is this one for early Alzheimer's disease. So that would be the study to watch for anyone that follows this stock. As I mentioned, it's not one that I currently own. And then there was one other question. Any opinions on UnitedHealth Group? I've talked about this a couple times today, so I won't get too much into the weeds there. For anyone that's curious, the performance of this stock today is one of the factors that has been weighing on the broader market. There have been multiple reports that have come out, but the first reporting was by the Wall Street Journal today that allegedly the DOJ is investigating UnitedHealth Group for Medicare billing practices. UnitedHealth Group is in a pretty solid financial position. They continue to generate pretty substantial revenue and profits from their flagship health insurance business, UnitedHealthcare, as well as their Optum business, which includes a range of services, including software and analytics and support services that they provide to healthcare providers, as well as a network of consumer-facing services such as care centers, pharmacy benefit management services, things like that. So the stock itself has been under a lot of pressure with all the developments and news around that company in recent months. They're still doing pretty well from a financial perspective. They have been dealing, like other insurers, with some headwinds from increased Medicare utilization rates. So that has weighed on the margins a bit. But the stock is down, I think, about 9 or 10% today on this news from the Wall Street Journal. So anyone who follows that stock, that's something to watch and be aware of and probably track in the coming weeks and months.
Okay, I've got another marathon question answering session here, and I'll try to get through these quickly. Foolish asked a minute ago, is cost basis and transaction history transferred when brokers are acquired? I can only tell you what happened with mine, and that is that when Charles Schwab acquired Options Express, they did transfer over the cost basis, and they sent me basically documentation and said, would you confirm this? They did not transfer over transaction history. Fortunately for me, I am somewhat obsessive with my spreadsheets, and I kept really good records of my own of the taxable account, not so much with the non-taxable accounts, because I'm going to pay taxes on everything in them anyway, so it doesn't really matter. But I still do have accurate cost basis for all of those. I don't know what other companies would have done, but that's what happened with mine. Sadaf said, Bill Gates recently reaffirmed Jensen's sentiments, referring to Jensen Huang, the CEO of NVIDIA, NVDA, that we are decades away from useful use of quantum computing. What's your take from Microsoft's announcement on a quantum chip? Microsoft ticker MSFT. I think it's great news that Microsoft is working on a quantum chip. I don't think it's something that we as investors will benefit from anytime immediately. However, as a Microsoft shareholder, I'm invested in Microsoft because they have some of the stickiest businesses around. They have their software as a service business. They have their computer business. They have cloud computing. and they are a leader in artificial intelligence. So while I think it's great that they're working in the field of quantum, and I expect solid things from them in the future, not one of the reasons I'm invested in Microsoft. Zaxa Fool says, what are your thoughts on diversification and/or asset allocation across tax-advantaged retirement accounts versus taxable brokerage accounts? I think it's a great idea. I wish it was something that I had paid more attention to when I was younger. I'm at the point now where it probably doesn't matter much. When I did establish a Roth a few years back, I tried to stock that with companies that I thought had the best potential for explosive growth and corresponding explosive stock price gains. That has worked out fairly well because one of the stocks that I put into my Roth account was NVIDIA, and that turned out really well. I think it's worth investigating depending on where someone is in their investing journey, because I think that can work really well. If you put your dividend payers in one type of account, you put your explosive growth stocks in another type of account, you can probably maximize your gains over the long term. There are probably others who are better suited to answer that question, so feel free to ask that of someone other than me, but I certainly think it's a great idea. And finally, Matt said 21 minutes ago, I wish that companies didn't offer guidance. That way, any changes in the stock must necessarily be based on the underlying business results. I agree and disagree at the same time. I agree that over the long term, stock results are based on business operating and financial performance. In the short term, however, if you look at the market today, there's a whole bunch of stocks that are down today. And they're down because of economic fears. They're down because of the potential for, tariffs. They're down because we don't know what's going to happen in the near future. None of that has to do with how the companies are performing. So I absolutely agree with your sentiment in principle. In theory, unfortunately, that's not exactly how it works out in reality sometimes, but that's just kind of the investing game.
Yeah, there's a few questions I want to try to hit in a row as well. Larry
Sure.
Fourcade Poker was asking about InnoData, saying the stock is up 700% in 1 year, it's been quite a run up. Thoughts on this company? Yeah, InnoData is actually, I checked, their stock is up about 20% today alone. For a few reasons. One, they just reported a really stellar Q4 and full year earnings report. They also had some analysts that were raising their price targets for the stock, which gave the stock a nice boost. For anyone who's not familiar, InnoData, they are a data engineering company. They specifically provide high quality training data for artificial intelligence models, which, as you might imagine, is in high demand right now. They focus particularly their data engineering services on the realm of generating high quality training data for generative AI. And while they haven't named names, their clients include 5 of the 7 magnificent 7 of the big tech companies. So they have a business that has been just absolutely witnessing explosive growth over the last few years. Back in 2019, I think the stock was trading about $1 a share. Now it's trading at more than $60 a share. But essentially, this core business that revolves around providing the specialized data that's required to train these sophisticated AI models with a specific focus on generative AI applications has completely injected a new wave of growth into the business. And they do primarily serve major tech companies, including 5 of the 7 magnificent 7. From what I could tell, they haven't actually identified who those individual companies are. So that is a left for us to guess. However, taking a look at their most recent earnings report, which just came out yesterday, their revenue for the fourth quarter was 59 million. That was up 127% year over year. Their full year revenue was about 171 million. That was up 96% year over year. Their net income for Q4 was 10 million compared to about 2 million the prior year. Now, their full year revenue, back in 2023, they actually delivered a net loss. So they're more newly profitable. But they delivered net income of almost 30 million, 28.7 million to be exact, in 2024. So record 127% Q4 growth, significant new partnerships positioned. They also said, and they again did not name which customer, but they said in Q4 and January, we were awarded additional programs and expansions with our largest customer, valued at approximately 24 million of annualized run rate revenue. These recent awards expand our total annualized run rate revenue with this particular customer to approximately 135 million. Now, they said we also grew aggregate revenues from our 7 other big tech customers by 159% in Q4 compared to the prior quarter. So that was 159% sequential growth. And they believe that this growth will continue into 2025 and serves as just points to the value of their underlying business model. And again, as they mentioned, you're looking at AI-driven CapEx spending among the Magnificent Seven, 5 of which are their customers. And as I mentioned, they don't identify which. That significant CapEx spending, you think of companies like Alphabet, they're saying we're going to spend 75 billion on AI mostly, but CapEx spending 75 billion in 2025 alone. So I think investors are very excited about this stock. I think the stock has had quite the run. I would be cautious as to whether it can retain that level of growth, over the next 5 years. But that doesn't mean it can't be a great investment, even if it's not delivering, triple digit gains there. So that's what's happening with Innodata right now. So I wanted to note that. There was also a question that had come in earlier from Shelm or Sheim. I'm not sure. What are your thoughts on Freshpet and Sweet Greens? Both are way down. I follow Sweet Green a bit more closely than Freshpet. Freshpet, I'm much more interested in Chewy. I think Chewy is a much more diversified and well-established business. I think Freshpet primarily caters to higher ticket level spending by pet owners, which could be really in flux in a more difficult economic environment. Sweet Green, I haven't taken a position partly because of their lack of profitability, but I've been really curious what they're doing with their infinite kitchen robots. So that's been really the developments I've been watching to see what is a very capital intensive venture, which is building a lot of these robots into their kitchens, how that's actually going to turn out and how that is going to contribute to their growth over time. And how will that affect their journey towards profitability? So those are a couple things I'm watching before I would consider a position there. And then we had a comment from Ed. Hershey's, a year of gains in one day. a lot of viewers like Hershey's. I like this stock too. That's a fun one. It's been a good day for Hershey's. Some of these businesses that maybe fall by the wayside a bit seem to be bumping up higher on a day like today.
Indeed.
And with that, we're at the end of our hour, and it's time for 2 amazing fools, Aset and Andy, to take over. Hey guys.
Hey Rachel, guys, how's it going?
Hi, Danny. Thanks, guys.
Good to see you both.
Good to see you all too. Have a great weekend.
Thank you.
Full on,
Hi,
guys.
Aset. Full on. Bye, Danny. Hi, Aset.
Andy, how are you?
Yeah, I'm doing great. Thank you. Wrapping up the week here on a tough market day. There's a lot of, with the exception of Hershey's, as Rachel was just saying, Aset, but it is
got to be one.
It is a little rough, and some of the healthcare minus UNH is trying to rally a little bit. But I'm Andy Cross, Aset Sharma. We're here talking foolish investing. We're both analysts on the stock advisor team and longtime analysts, and we're excited to be here for the next hour. Whether you're watching us here on the Motley Fool site or over at YouTube, it's great to be here. And of course, we can't offer personalized financial advice. This is really for informational purposes only. But Aset, what are you looking at today to kick us off?
Yeah, so today, Andy, I'm looking at something a bit topical, a news item here. Some news out today that the EU is getting ready to drop some charges against Alphabet's Google for search bias. They've been investigating Google since last year on its search engine, basically saying that Google doesn't comply with privacy initiatives under something called the DMA, the Digital Markets Act. So this is on the European continent, big tech operating there. You have to follow their guidelines. And, just thinking about this in terms of the puts and takes of investing in big tech. As we know, Andy, over the last couple of years, Magnificent Seven, big tech companies in particular, have pushed the indices in a concentrated way to the all-time highs. Of course, a little bit off today, right?
Yeah.
But those gains, come with risk. And this is just a good reminder that the very companies that often push the market forward often have some risks and vulnerabilities that investors should be aware of. It's always a good idea to look across the entire S&P 500. And in fact, the entire universe of investable stocks here in the US and abroad. So just something I'm looking at today. Nothing that's going to really spoil Google's momentum, but it could shave a little bit off in terms of some regulatory fees. We'll follow this story in the coming weeks.
There's a question from Let It Ride that we'll get to in a second. And Asad, I'm looking at one of the tech consultants. Tech consultants have had a little bit of a rough ride here this week. Globin, GLOB, is one company that I follow. It's down more than 20%. And they actually had a very nice quarter with acceleration on their revenue stream, Asad. But their guidance for the year, as often is the case when companies report earnings and then they talk about what they're looking at for the next quarter or the next year. And in the investing community, the trading community really locks onto that because that helps set up the valuation. And Globant said, hey, our growth is going to fall from more than, teens 20% level, 20%, more than 20% last quarter for one of their largest clients, Disney, down to less than half of that probably going forward. And their whole revenue, the revenue model throughout this year is going to be a little bit less than expectations were for the year. Investors were expecting a slowdown, Asset, for Globant, GLOB. But I think not quite this much, and that's going to hurt a little bit of hurt some of the earnings per share growth for this year too. This is a company that's very forward thinking. They help companies become more efficient. They have large clients. I mentioned Disney is their largest clients, but they have lots of other clients. But Disney's going to see a little bit of a slowdown. It was an exceptional year for Disney. I think they were up like 24% on the sales side for the year or maybe the quarter for Globant. But that's going to slow this year as one would expect. And I think the market was expecting that, but maybe not quite as much. And the stock really has sold off. But now, Asa, you have a company, you have a stock that's selling on a cash basis. When you look at their earnings just for this year, you have a business that probably is selling at 22 to 23 times earnings with the potential, I think, to have more than 10% earnings per share growth probably for the next few years, depending on how some of their investments play out. They also are seeing a little bit slowdown in Latin America, which is a core market for them. So you see in a market that is pretty visceral today, selling off, and when a company kind of reports a good quarter, but maybe the forecast was a little bit on the lighter side, you can see it's a very stiff reaction for a company. I think maybe a little bit overreaction for that stock today, but one that caught my mind when I was going through our list.
Awesome, Andy. I love the whole explanation of sort of today's fall in Globant shares. I follow that company as well, and maybe we can return to that later in the hour and chat some more about it.
Do you want to take Let It Rise question? Just came in. Please rank the following: Microsoft, ServiceNow, Salesforce, Google, and Apple for 5 to 10 years at current valuations. The Stock Advisor team, you and I and Asa, we were talking about many of these companies just yesterday. I think of these, I still am probably most encouraged by Google. You mentioned some of the challenge, and they do have so many challenge regulatory. What happens with the threat from some of the generative AI, although they are now finally catching up to that market. What does the advertising market look like? But I still, from a valuation perspective, from an opportunity perspective, I think Google still, and from just the fact that it generates loads of cash and has one of the best advertising platforms out there in YouTube, I would probably put Google at the top of that list, followed by, probably somewhere like in the Microsoft or Salesforce. ServiceNow is a great company, but the valuation just got to be, a little bit rich. And same for Apple, I think, when you're paying 30 to 40 times earnings for that kind of business, I think, well, I use their products, multiple products every day. I think it still just gets a little bit excessive on the valuation side. But of course, for 5 and 10 year holds, valuation matters, but maybe matters a little bit less. But what do you see in that list, Asset?
Yeah, Andy, it was probably a couple of years ago, maybe even 3 years ago, I mentioned to you in passing that Alphabet is such a complex company, and it's one that I really haven't sunk my head into. And I feel that with all the strides that the business world has made with the explosion in generative AI over the past few years, I've been forced to pay more attention to it. And I come out the other side sort of a fan of this business. So I also think that despite regulatory risk, Alphabet has many ways to win. We were chatting yesterday about YouTube being such a force multiplier for this business.
Yeah.
And also chatting about on our live reveal in Stock Advisor, the fact that the search results, artificial intelligence powered search results in Google haven't been a detractor from that business. They've actually helped support the ad revenue. And I like their investments in the cloud. Lastly, I think that the credentials that Alphabet has in the generative AI space are undervalued by the market. They have for many years had lots of great engineering talent and scientists who develop great technology, and we're just well suited to step into the world of LLM. So I think we'll see a lot of innovation coming out of Alphabet in what Gemini provides, not just to the public, but to developers. So those who use the APIs that Gemini provides and develop new products out of those. So yeah, I'm liking Alphabet, as you put it, in the context of a valuation perspective. That's what Let It Ride is asking about. As some of you may know, I'm a fan of ServiceNow. I do feel that myself it got a bit pricey here, but for the long term, it is one company where you can see very consistent, real results coming out of its AI sales to enterprise businesses. I think Microsoft maybe feels fairly valued here, but a solid company. I would say out of this list, the one that I'm most interested to study a little bit more is Salesforce.com to see how they do with this big push into selling agentic software to companies. It's a well-diversified business, one of the few businesses that does acquire well and does it right. And then Apple, I think, it just begs a little more study for investors to try to understand where the gains are going to come from. Okay, we're looking at a 5 to 10 year period. So you put Apple in its valuation context. I just want to know more about how it will grow. Is it just product recycles and refreshes? There's some new innovation coming. I know we didn't end up ranking them, but I think just talking through the strengths and weaknesses may help Let It Ride get a sense of where we sit on these.
And the other thing is, other investors, we talk about this, a business that is, fairly valued when you look at cash flows it can attribute and you give it a multiple and you kind of play it out, doesn't mean the stock price is just going to be static or go down. It just means it basically will grow at its cost of capital, and for which many of these companies is kind of probably in the high single digits. So if you look at a business, you're like it's richly valued or it's kind of fairly valued, like maybe something like a Microsoft might be. The math works out that a stock can kind of grow at its cost of capital in the, at this point, maybe in the high single digits. So they can still be decent investments. It's just that when you're looking for the ones that are the best opportunity, as we do every month when we do our rankings or we do our recommendations or our recommendations in Stock Advisor, that's what we're trying to find, the best opportunity or the relative best opportunity. And just because a business is kind of on the foolier value side doesn't mean the stock can't, especially over, 3, 4, 5 years, can't go higher from here.
Totally, Andy. One last thought on that. I didn't mention Apple's balance sheet, for example. I mean, that itself is such an asset to the company. There's so much they can do with that in terms of investment in innovation or buying back shares. So this is, again, very much in the context of valuation that we answered the question.
Yeah, and just all the shares they're buying back. I mean, that alone is making the current, when a company buys back stock, the current shares benefit because it makes the value of the current shareholders, what they have, incrementally higher just by holding the shares, by company lowering the number of shares that are outstanding for the calculation. And then hopefully if they're doing it at below the intrinsic value of the business, then it really starts to compound as Apple has done over the last few years. Now, right now it's probably, I don't know if it'd be the best use of capital, but they're still buying back a lot of stock.
Yeah, and it's so funny, Andy, how this works for maybe newer investors who are just curious, like, okay, if you're buying back shares in the open market, and I get it's theoretical, Warren Buffett talks about the owners getting a greater share of profits, right? So this is one of the things when you buy back shares on the open market, you reduce the number of shares outstanding, your common stock outstanding. That means if theoretically, if a company like Apple were to distribute all its earnings to shareholders, you and I, if we were shareholders of Apple, would get more at the end of the year. But companies usually don't distribute all of their operating profits or net income unless, maybe they're REITs. So how does this work in the real world? Well, it works because most investors, when they value a company, say, okay, if Apple did distribute those earnings, I'd get a bigger share if they have fewer shares in the open market, so I will pay more. So it's sort of this abstract adjustment that many investors make. There is another side of it too, that over time, if you do substantially reduce the shares that are out there in the market and you have a catalyst in your business, it's supply and demand. So there's more demand for shares, but there are fewer out there. Now, not every company can pull this off, but we see some companies who over time really reduce that share count, sometimes get that positive effect when they have a good piece of news to hit their business.
Yeah, pivoting away from that, Melissa had asked a little bit, I think Rachel was on, who really studies pharmaceuticals and biotech and healthcare, but talked about NVO, our recommendation stock advisor, Novo Nordisk. Also, just very quickly, when someone looks at the chart for Novo Nordisk, they might see, wow, this stock is down pretty significantly from its highs in 2023. What is the team seeing? Why would they do that as opposed to buying into a stock that has maybe some momentum behind it? But there is a lot. There's also a question about competition, but there's a lot behind the Novo Nordisk story that we like, especially because a lot of investors have been selling off the stock, and we think there's some underlying value there that's not being appreciated in the marketplace.
I agree, Andy. And sometimes we do buy stocks that are exhibiting momentum. That is one of the traits that David Gardner used to espouse and still does, although he's not actively picking stocks, which is pay attention to signal. If a stock is rising, it may mean something good. You should study it. So while we do have picks that maybe lean towards momentum, we also love a great story when other investors are sort of walking away. And what we see in Novo Nordisk is sort of a story that's been played out in other markets. It's played out within the pharmaceutical industry. And that is when you have a blockbuster complex of drugs, for a certain time, you may rule the market, as Novo Nordisk has, and then you may trade some market share off with big competitors. Eli Lilly is the primary competitor to Novo Nordisk being a smaller company, in the market for GLP-1 drugs that are directed towards first diabetes and now, of course, weight loss, as everyone has seen over the past few years. And we're in the part of the cycle where supply and demand, coming back to that concept, got a little bit out of whack. So both of these companies and others who play in this space have and are having to invest in their manufacturing and distribution for the sort of the next wave of business. In the meantime, you're looking at Novo Nordisk, which had a competitor drug to we always mispronounce his name, Zerpatide. I'll have to make sure I get the pronunciation of this correct. But at any rate, that trial, which was a flexible, open phase of trial for a drug called CagriSema, didn't meet investors' expectations. So you had two things going on. I've just described the exhaustion of that first wave of enthusiasm over GLP-1 drugs, the need for the manufacturers to sort of reinvest, so taking a breath. And then the second whammy, which was disappointing results of this trial, which actually showed pretty good results. So the long-term value of commercializing this drug, we think, is going to be very important to the Novo Nordisk story. The company has a pretty strong balance sheet, and it's actually invested about $20 billion over the last year in expanding its manufacturing through the acquisition of a company called Catalent and buying some of the manufacturing facilities that Catalent had. So these types of things require patience, these setups. And when we see them, and we see a company which is growing revenue in double digits and has the ability to continue to do that, although, Andy, maybe not at the pace of 20 or 25%, but certainly in the high to mid-teens. Let's look at that area, and can do that for a number of years, and also has a really strong pipeline of drugs. That's just a good setup for investors who maybe own the stock and want to buy some more. This is a re-rec on the Stock Advisor scorecard, or investigate it to add to their portfolio. So basically, two ways to look at investing. You can always buy on the way up, but sometimes the best investments are the strong companies with high returns on invested capital with very, very decent, I would say vigorous markets in this case, when we think in terms of GLP-1 drugs. That long-term trajectory is good to step into today and be patient to wait that out 5, 7, or 10 years. Can be pretty promising.
And it got some good news today, which is the stock's up 5%, which is nice to see on some of the supply dynamics, which I think is actually hurting Hims Health, HIMS, the stock that got a lot of notoriety during the Super Bowl for that commercial. So, but you're right, Asit. I mean, with the strong balance sheet, the valuation attractive, the expectations are kind of more just, I think, a little bit kind of like steady Eddie, and the look over the next 3 to 5 years with that pipeline, that positioning, we think that's still an attractive opportunity globally. And it is a global stock, which is also nice to help diversification. And I think a lot of maybe investors have kind of not spent a lot of time in the healthcare field as much as maybe in the tech or growth field. And so for those looking for diversification, NVO continues to look, pretty attractive, at least to us.
So, Andy, maybe we'll stay on the pharmaceutical side for a moment to tackle Matt's question. Are you more bullish about ResMed's business or the future of Ozempic and its GLP-1 equivalents, or do you think both can be winners? So I'll take a quick stab at this. I think on the Stock Advisor team, which Andy and I are both analysts on, we feel pretty good about the prospects for ResMed and the industry in general, which we've just been talking about. Two companies. Eli Lilly is not on our Stock Advisor scorecard, but it certainly is a promising company in that space. Now, an investment in ResMed isn't without its risks. In fact, just recently, Lilly, which has the brand name Zepbound, received approval from the FDA to treat obstructive sleep apnea with this drug. And I'm going to try it again. Andy, this is the correct pronunciation. Tirzepatide.
Tirzepatide.
So, mangled it the first time. But basically, to use tirzepatide for patients who might get hooked up to what's sort of a ominous-looking machine at night, just in order to have an unobstructed airflow. That's what ResMed specializes in. So while we think the market for that is still strong, it's not without its risks. On the whole, on the balance, though, I would say we're pretty excited about both the ability for specialized makers of medical equipment to flourish in markets. This is just one example. We have some other on our scorecard that also treat the pharmaceutical market as a device-based revenue stream, and the ability for certain companies to just put in those billions, Andy, into R&D and come out with drugs that will help society. So yeah, I would say we like both, but with ResMed, we're still sort of studying, I think, what the intermediate and maybe long-term effects of a non-equipment treatment might be on its market share.
There's a lot of good questions. I was just scrolling through. Thanks for that, Asa. Just scrolling through lots of great questions about like stock is down. It's been falling. Not NVO or ResMed, but just in general. And I think that gets to a little of the things we're seeing today, Asa. And some of the consumer confidence numbers came out. Some concerns. Just there are just the feeling that after, as I wrote, just published today in a piece that talked about, it was a really good 2 years. And well, even more than that, really 3 years. But after 2022, when the market bottomed, and really that fall, during the fall, when OpenAI released its first generative AI model to the public, really the chatbot. And, it's been a very, very prolific market for so many parts of the market that people have really gravitated to. And so we're seeing some of these stocks, I think, just, Ed had a question about MCore, EME, which is down. I bought that myself, Ed. So I also am down on that. I was looking at my position today. I think I'm down probably somewhere between 15 and 19% on that since last year. And, just that company, which is tied to data center build out, providing services to data centers and other building constructions.
And a specialist in its field. I mean, very specialized electrical construction. But
right, exactly. But I think a lot of the excitement for the past year and a half had been around the data center build out, and just you're starting to see some of those just with. Even though Arista reported, again, very impressive numbers, and even their guide was still impressive, and NVIDIA coming, I do think we're just seeing these stocks, whether investors or traders are taking profits or, just being like, hey, these the multiples maybe got a little bit, and that extended, like I was saying with ServiceNow, even though it can be a great company, and I'm still an excited owner of MCore, but the ups and downs in the markets when investors are just kind of like shifting the sentiment. I'm seeing a lot of that kind of thread into the questions, but specifically about some stocks that have come down the past, call it 3 to 4 weeks or so, Osset.
Yes, I agree, Andy. Many of these stocks have had very nice runs, and sometimes what you're seeing is just an adjustment of the multiples to solve for one thing or the other. It could be uncertainty, going forward. Are they going to be able to keep up that fervid pace of expansion? Let's say in MCore's case, what if sort of data center builds slow down, which I'm actually pretty confident, because you have to plan those data centers out years in advance.
Yeah.
So any real slowdown in data center build out is going to be sort of like a big Navy ship slowly turning in the ocean. You just can't like turn it around on a dime. But there's also, uncertainty regarding potential tariffs. We still are seeing the effects of persistent inflation. The consumer side is starting to look wobbly, so consumers have helped stabilize a good portion of the market in consumer goods stocks, anything consumer facing, and maybe consumers are a little bit exhausted. So there are many things which point to perhaps not the kind of year we've had, as you mentioned, Andy, over the last 2 to 3 years. But it doesn't mean that companies you might have bought 4 or 5 months ago won't be outperformers over the long term. They could outperform a poor performing market.
Yeah.
They could rebound very strongly when markets start to surge again. So for me, again, I think this will be a theme for this hour for me. Patience really helps in investing.
Well, and diversification, owning lots of different businesses, building all those stock advisor principles that we love to discuss, which is own at least 25 stocks in your portfolio. Aim for a holding period that, averages like 5 years, or at least that's the mentality you want to take. So when your stocks are down 10, 20%, but they continue to report decent revenue or earnings growth or productive asset usage from a returns on capital perspective, they still have good fundamental business things going on them, like Globin, but at various points, the valuations might get a little excessive or a little not. But if you try to trade around those, Austin, I think that's where you get a little bit concerned. So just my guidance is to like Austin, like you were saying, that patience. But as long as the businesses are continuing to deliver, they just might not. All businesses don't grow 30% a year or 20% a year. That's not how they work, even over 3-year periods. Not all businesses.
Yeah, very, very much so.
Even the best ones don't.
Even the best ones.
So.
And really quick last point on that is that the idea of trading in and out of these is very seductive, I think, for many people who might not have had a lot of time in the market, but it's psychologically very difficult to do. Sometimes you'll pull out of a great stock after you've had a run in your own portfolio. Maybe it's only down 5 or 6%. You decide to lock in profits.
Yeah.
It goes down more. You feel great about yourself. I've had this, and of course, I'm so egotistical. I'm a genius. Right. But what happens, Andy, is I'm asleep at the wheel, or it's just impossible to really time these. The next quarter comes out, there's a great report, and the stock is surging. It is so hard psychologically to get back into a company that you've sold when you've either taken a profit or even sold at a loss. So if the thesis isn't broken, if the thesis is intact, just try to hang on to a quality company and look at that as a long-term commitment.
I think that's exactly right. The thesis intact. Clay asks, how does someone diversify a portfolio across different sectors or companies? I said diversification. We talk a lot about it. You can buy lots of different businesses, that kind of thing. You can also use ETFs. But any thoughts for Clay on that? Again, not personalized financial advice for anyone, but just in general, some ways that investors can diversify their portfolio.
I think it's a very good question. And the answer is, first, you have to take a look at your portfolio, take a step back and understand how it's constructed. That's the first order of business. Some people have great diversification across many industries, but there's one overriding commonality. You're all the way in just the tech industry. Maybe you've got semiconductor stocks, software as a service stocks. You've got some that sell things to consumers, but they're all tech companies. So one thing to think about is this idea of sector diversification. Another thing to think about when you look at how your portfolio is constructed is, how does it sit vis-a-vis risk and volatility? You can do this easily by plugging each of your companies into some Fool tools that we have, or if you want Yahoo Finance, and looking at the betas of those companies. How volatile is each company in your portfolio in regards to the market, in relation to the overall market? Is it above or below sort of that median line? You go ahead, Andy.
Essentially, beta is just a measurement of just very broad, just very simply, it's some kind of measurement of volatility against the market.
That's a great way to say it. We could get more detailed, but that's a really easy way to understand it. And then, interestingly enough, Andy, I would say to be able to diversify a portfolio with some meaningful effect, you have to get outside your own comfort zone. Most of us gravitate towards building portfolios that reflect our aptitudes and our interests. There's nothing wrong with that.
Right.
But simply because I happen to really like, for the past couple of years, semiconductor companies, doesn't mean that I shouldn't be seeing if there's some good consumer goods companies, or maybe a few dividend paying companies that are solid return on invested capital businesses, to balance things out. So I think when you do all these things that I've mentioned, and then just let yourself tilt it a little bit towards your own overall risk profile. Okay, I want to be a little aggressive, or hey, I would love to conserve my capital. Get that last portion of it right. And that has to do with how much of positions are allocated versus one another. How correlated are the positions? Is there one outlier that's 10 or 12% of your portfolio or more? Do you understand why it's so? Is that what you want? Or should you manage that? I think for me, this is how I look at the overall idea of diversifying a portfolio.
I think about 30 stocks, 3% positions equal. If you're doing if someone's doing equal weighted positions, it's 90%. You add 10% cash position roughly. And then I use that as kind of a base. Now I own more than 30 stocks, at least twice as much. Actually, maybe even 3 times as much now if I add in all of the holdings across my family's portfolios. So roughly that kind of like thinking about the types of stocks, but also the allocation and making sure your allocations match up, not all in just one industry. And then ETFs from a diversification perspective can be very good, very cheap, nearly free Vanguard ETFs to get wide diversification across lots of different markets and parts of the market, like the S&P 500 or value parts of the market, or dividend payers, those kinds of things. ETFs can also be a neat way to help diversify.
Andy, can I ask you a follow-up question?
Oh yeah, please.
So if an investor likes to pick stocks, or wants to learn how to pick stocks, or make that the bulk of his or her portfolio over time, or their portfolio over time, do you have any just sort of thumbnail ranges of what makes sense hypothetically in terms of the ETF portion of a portfolio?
So I'll just talk about my personal portfolio. I would say, I think I told Tom this maybe last week or 2 weeks ago, maybe about half of the overall capital I have invested, or somewhere between 25 and 50% is probably in ETFs if I include all of my 401k capital, because we offer at the Motley Fool ETFs, and then you can also do a self-directed into stocks or whatever you choose, but I choose stocks in that case. But overall, then I have a whole bunch of holdings in taxable accounts. But I think overall it's probably, so call it 25, 75 for that, for me. And so I've been investing for 30 years. So I think in general, ETFs, especially for newer investors, can be a great way to start. Because again, Asit, fees are so important, and those ETF fees, especially at places like Vanguard, are just so cheap, and you get wide diversification across the marketplace. And so just starting with ETFs as someone is building out towards a 25 or 30 stock portfolio, and having ETFs be half the portfolio or something like that, and the rest adding to stock. So just some overall ranges there that might be able to help. But what do you say?
Right in there with you. I think I did a calculation the other day. I'm somewhere around 30 to 32%, but I've been trending upward. Not because I don't think that picking stocks is a way to make great money. I think it's one of the most fun and best ways to make money over the long term. But just the lift you get out of some thematic ideas or following the broader market without having to worry about it, this forms a good core of many portfolios. So I like that. So we'll say somewhere in the 30 to 50% range sounds reasonable.
RT R2D2 talks about this, Austin, and maybe we can hit this because there's so many great questions we can maybe just kind of go through. But Rule Breaker our Rule Breaker service founded by David Gardner, says don't buy the dip. Add to your positions on the uptrend, which he does. I think colloquially we've talked about dips, buy the dips, and you want to be careful about trying to catch a falling knife because a lot of times those knives can fall, as we saw. Now sometimes they can turn, as we saw, with the likes of I think maybe Celsius today or yesterday, Asset. But he can. The person continues to ask. R2D2 asks, what are your thoughts on recent drops and then ups like Celsius, Upstart, The Trade Desk, or others you like? So I will say just anecdotally, one lesson that I take away that I thought was so insightful. We recommended in Stock Advisor Netflix many times, Asset. And for those who recall, during the Quickster debacle when Netflix was kind of like separating its business and it created this business called Quickster. Over the course of about a year, I think it was somewhere around 13 months maybe, Netflix stock had fallen like 70% or something like that from its high, very dramatically. And we had recommendation against it and we just held on to it. And then the stock turned, they decided not to go the Quickster route, the business, and then, the rest is history. But we had then come back with a re-recommendation of Netflix, but not at the bottom, after it had started to climb up, and the stock had gone up a pretty significant amount, and then David had re-recommended it. And my takeaway was like, you don't have to always try to bottom tick a stock that's falling on its way down, but if you are catching it back when its business is turning around, maybe they hit a slow patch and they're turning, whether it's revenue or a company like PayPal that we still like that is turning around. It's not necessarily if it just is 10% off the low or 20% off the low or maybe even more, thinking like, oh, I missed the bottom. And we're all guilty about this. Oh, I missed the bottom. It's too late now. If the business again has that momentum, and I think that's the spirit of the question, is like, you know what, there can still be a lot of potential upside if the thesis on that pathway they are now on versus where they were when you're doing a Quickster pivot is completely changed. That can still be a great time to be buying a good business as the stock is moving higher as opposed to trying to catch it at its low.
I agree. And I think both are okay. I buy some businesses on the way up and I certainly buy stocks on the way down, but something that you said, of course, resonated with me. You pointed to it being about the business, what the business is doing. So if you have a handle on that, it's much easier to buy a dip versus the potentially emotional activity of buying on the dip because you've got some money sunk in the proposition and you want to be able to make that good. So you're sometimes rationalizing, I'm building my cost basis. I would advise against doing that. An easier way to approach all this is to dollar cost average in. So this is one thing where you can buy while it's going up and on the dips if you buy consistently in a company. But sometimes you will notice, okay, so we've got businesses that rocket up like Upstart into the $400 range, then go all the way down to the 20s. I'm talking about Upstart because the member mentions it.
Yeah, that's UPST is the ticker for Upstart.
Sorry,
UPST,
yes,
yeah.
UPST. So in cases like that, you really do have to study the business and make sure that you feel comfortable about what the trajectory is.
Yeah.
But neither is really antithetical to long-term returns. The situation is what calls for everything. And Andy, I remember briefly on Netflix, it had a similar second eventuality. And this was only now 2 or 3 years ago in which they decided not to publish, various numbers. And the stock seemed like it was at a crossroads. The market was also coming off a peak. This was right after the 2021 period. And it had another, not as dramatic fall, but another fall. It was at least 30 to 35%. And, this goes to show with some truly great companies, if you believe in management, you understand the business model, and the demand is there, the product is there, those can be opportune times to get in.
Absolutely. Dollar cost averaging, DCA, is that idea. In Stock Advisor, we talk, one of our flagship service, our first service started by Tom and David Gardner, talks about buying in thirds. It's when you are starting to position in a company, buy a little bit, commit to buying a little bit more, commit to buying a little bit more, just emotionally for most individual investors. Because if you buy and something like MCOR happens and the stock falls 10 to 15%, or it goes up 10 or 15%, I think just over time, that just helps balance out some of the emotional toil that we take as investors when we're allocating our capital. Because we are, even the best investors are human.
Very true. So, Andy, there's a question from Hitesh about Globant. I know we mentioned this briefly at the outset. So maybe Hitesh is just tuning in, symbol GLOB. It's fallen 26%. It's still falling after what seems to be a good quarterly results. Any thoughts on that? And I just wanted to recap, what you had said briefly, that there's really, we're looking at a company which is very innovative in its field. It's one of the better consulting plays out there, was well-diversified business with a nice cost structure. So they're expecting a little bit of lower revenue from some major of their customers, including Disney, or Disney is the main one. So I think the market is probably adjusting the trading multiples a bit for the forward expectations, which I believe, Andy, are around the 8 to 10% range. And you mentioned that this company has been growing in the 20s, high teens. So I think we see these resets come with, especially the consulting companies. Their outlooks can be lumpy. That's maybe a bit par for the course with smaller consulting companies. Accenture may be one that's not as prone to these jagged results after earnings, but certainly the rest of the consulting industry seems to be. And I would just throw out there too that it's very important to follow any technical consultant's approach to artificial intelligence. And Globant is one in particular that I've always admired for being forward in the AI space, for working on hard problems before other companies. So I feel that they are relatively well insulated from the idea that maybe you'll have less business as an AI consultant or as just a tech consultant in a world where so much of programming expertise is directly gleaned from large language models by talented developers. I think they're more insulated against a loss of business than some other models I've looked at.
So, Asa, 2 points to that, because it was very interesting. They talked a lot about their professional services. So one of the verticals they serve is professional services, and that is kind of like consulting like services, and it's like helping companies do more with their assets and technology and that kind of thing. And so it's not like in the just pure entertainment, which is like the Disney business, or retail, which is another vertical they serve, those kinds of things. And they talked about the weakness in professional services. It does start to get to that feeling. Globant doesn't really have, I don't think they have really big government contracts like the likes of like an Accenture or a Booz Allen. But as companies are getting more and more efficient, maybe with generative AI on their own, how is the need for consultants like Accenture or EPAM Systems, which is also down today, or Globant? And I am thinking a lot about this. Again, I think there will be need, and they talk a lot about the need for AI solutions. ServiceNow has talked a lot about this. Salesforce has talked a lot about this. But it's just the degrees of how much they need to, how much companies need that excess spend, the marginal spend of dollars in professional services that they need. This is something that hit Manhattan Associates recently, that they need, that they normally would spend because they have now internal tools from different generative AI tooling that they can do, and they don't necessarily need some of that spending. So I think we're seeing those dynamics work their way through, and that is also impacting some of these companies on the consulting side. Now, I think the valuations are getting just so much more reasonable that for businesses that can still be, Globant has profit margins in the mid-teens, the revenue pictures in the high single digits, low double digits. You start to add those up, and if they can sustain that, because companies still, even all that, what I just said, they still are saying, gosh, I'm overwhelmed with so much solutions out there. I need some help. Globant, can you help me? Because I don't want to go off and hire a bunch of people, even contractors, to do this. I can hire much more flexible digital consulting services like those from Accenture and Globe and the rest, I still think that demand will be there, just maybe on the marginal dollar side, not as much as we may have thought, say, 6 months ago or 9 months ago.
Yeah, I like that framework, Andy. And it could be that that dollar expands, that marginal dollar expands within the next 1 to 2 years a little bit. So counter argument to those who rightfully point out that you can do so much with AI, especially if you have a good team. Any company that's project-based like Globant, so is very used to having a specific goal and a deliverable. Example, okay, I'm a banking company, so help me deliver a new functionality to my customers. I need to enhance this app and do it well because I don't want any, with bank, I don't want any glitches in the software. Of course, internal staffs, internal software engineers all over the US and the world are being asked by CFOs and heads of IT and chief technical officers, well, can we do this in-house? So I think some of this reduction in marginal spend is companies avoiding or delaying, pushing out those projects to see what they can do in-house. And I think in many cases, the answer is going to be, yeah, we did it, but we were pulled off of other things. We didn't really do it as well as we could have the way and Endava or Globant used to do it for us. And, we're happy to do it again. We're using the AI, but that's not our calling in X department. So it's still, I think it's going to be a few years before we really understand what kind of benefit or hindrance this is to these consulting models. But I do like Globant's positioning in all this.
Ed asked about Axon and the trade desk, and AXON and TTD is the trade desk. Axon was down a little bit significantly this week on an announcement of their partnership changing, and the trade desk after earnings talking about some of the challenges the trade desk is seeing, and then we did a special for members. Tom Gardner and Dan Kaplinger and I talked a little bit, about the trade desk. Which is a better buy? I said, I think I'm going to lean the trade desk on this. As much as I really respect and like Axon, this for me comes down to a little bit of valuation. And even with that pullback, Axon is still a little bit more expensive. Trade desk with that fall very dramatically gotten down to about a $40 billion market cap, and more reasonable on the earnings and the revenue multiple. So I'm gonna lean trade desk on this one after that drop, but I don't think I would have said that maybe 6 months ago.
Yeah, they're both such quality businesses. I follow Trade Desk a little more closely than I do Axon, but have been an admirer of Axon's technology and the way they've gone from region to region, and just able to sell their technology to law enforcement and many other buyers. I like their innovative cycles. So yeah, to me, fair enough. Because right now, Trade Desk is really, even after its earnings, it's continued to deteriorate a bit, the share price. Yeah. So just the idea of being able to pick up a really great company that has both domain expertise and data with its customers, those are like two differentiators that stand out to me when we think about a company's ability to use AI or generative AI to its advantage. Because frankly, anything anyone can do is not that hard to replicate in the future world. So there are no purely technical advantages. I might build a mousetrap, and then Andy next week may come back and say, hey, I took your mousetrap and I showed it to my AI, and guess what? And then he pulls his, and this one can catch 2 mice at one time, Osset.
Yeah, right.
So this is what the future is like. So who has the expertise, and who has customer data that they can really make shine for that customer? I think those are great advantages. The Trade Desk has those in spades, but you couldn't go wrong with either of these companies if you're thinking for a truly long-term period. They're both high-quality companies.
Yeah.
And let's see here. So go ahead.
I was going to say there's a post from Ajit Jain, which is the great insurance person from Berkshire Hathaway as well too. So Ajit, if you're paying attention, can you folks shed some light on CrowdStrike and GEV keeps falling? I'll say CrowdStrike had there was an interesting report about some potential, Bloomberg had reported some potential investigation, some accounting that CrowdStrike, apparently I could not verify this, but CrowdStrike came out today and said, no, all our accounting is up to snuff. But I think that is hitting the stock a little bit. I don't know. I have not seen about GEV, which is GE Verona, right? GE Verona, I think is I've not seen that. But CrowdStrike, again, it is one of these businesses that I think is kind of like core fundamental when it comes to its space. It does cybersecurity. It has its Falcon platform. It sits more on the edge, although it certainly is in the cloud. It sits more on the edge, has software on various computers. Had a very public software update challenge last summer that put 8.5 million Windows computers into the dreaded blue screen of death, and stock sank. It had recovered all of that back from those lows in the summer. But it's one of those businesses that is driving a lot of free cash flow. It has exceptional growth profile, but the valuation just at some point might just be a little bit more on the richer side, and investors who are just in it for 6 months or 9 months or even less, also maybe like, hey, I got my 20%, 30% gain. I'm kind of out of it. And so the long-term case for CrowdStrike, I think if not all the metrics for CrowdStrike continues to be impressive on the growth side. They might not be accelerating as fast as they would have maybe a year or two ago, Osset, on the growth side, when you look at quarter to quarter. And momentum investors love to see that. They love to see ones that are doing what they call beat and raise, which is companies that they have estimates. This is what the trade desk always exceeded all of its estimates every quarter since it went public, except for last quarter. And I think that was what the investors were like, whoa, and they just threw in the towel. Traders, investors. If companies that continue and have done that historically start to show a little bit of softness in that, you'll see a lot of momentum investors start to exit the stock, especially if it has maybe a little bit of higher multiple. And we could see that with a company like CrowdStrike. And I think just that whole market got to be, I think after last year, the valuation started to get a little bit on the stretch side.
I totally agree with all of that, Andy. I mean, about CrowdStrike, I would say that this is a momentum stock that deserves its momentum. So it's a rare species out there. Most momentum stocks, they're riding on more and more traders piling in, but there are certain businesses that have a consistent way of growing and have a lock on their markets. Not that CrowdStrike has a lock on the cybersecurity market, but for what it sells, it really has deep relationships with its customers. As you mentioned, with the Falcon platform, it's just able to sell more and more to customers, and they willingly buy additional modules every year. So here we have a company that is, just extremely volatile. Andy, I'm running my cursor over a sort of a Java chart. I think it's on Yahoo Finance. We're looking at a high of 387 only in July of last year, and then quickly down to $218 like a month later.
Yeah, it didn't crack 200, right? I don't think it cracked 200.
It didn't, but it got close. And then all the way up to $456 just a few weeks ago. And about 15, I'm just guesstimating here, 15% off of those numbers, 472. And that is to say that year to date, this company, in this young year, is still up 18% after falling, 15, 70% off of its high. So sometimes you have to deal with this with an exceptional company.
Yeah.
And of course, the big fall last year was event driven, not to gloss over the fact that they had, a major issue that caused some angst among its customer base, but recovered nicely from that.
Let's take Mark's question because it's so good. I am new. So sorry if my question is weak. Mark, your question is not weak at all. Welcome to the Motley Fool. Thank you for posting, and thank you for being here on Fool24. But you do ask a very difficult question, and here's what I mean. Can you recommend lower risk ETFs that won't tank if the market collapses, but still grow 10% more or more per year? So Mark, you essentially want to have your cake and eat it too. So companies that have low downside, 10% per year. I mean, the market has grown 10% per year over long periods of time. So, Mark, you essentially want market returns, but not the market volatility. And Asset, that is difficult to find, especially in ETFs, low risk ETFs or ETFs in general. When I think about that, I start thinking about dividends. The market history tells us, Asset, that dividend stocks tend to be a little bit more resilient during market downturns. And I think that's true when it comes to something like the dividend growth in ETF and the dividend ETF. But Mark, it is a very difficult thing to do, to find low downside and still market upside. Asset?
I agree. There are things you can do if you're trying to at least approximate this kind of have your cake and eat it too. And why shouldn't you? I mean, if the market before adjusting for inflation in many years does 10%, why wouldn't you try to have those same results with less volatility? There are some minimum volatility ETFs. You can Google those that track the S&P 500. They're equal weighted versions of S&P 500 tracking ETFs, which may be a little less volatile because they don't ride on some concentrated names producing gains. But over certain periods, they will trail the market because the ones that are capitalization weighted, when they take off, they take off. I myself like to find growth at a reasonable price type ETFs. So you can Google those up too. There are a few well-known. I won't, because they're not really Motley Fool recommendations. I won't get into recommending those specific ETFs that I invest in. But those are ways that will sort of, get you close to what you want. It may not be in any given year producing that real sweet spot, the little bear sweet spot. Or was it, Andy, which of the bears had the sweet spot?
The sweet spot. Was it well, I don't know.
I'm mixing up fairy tales.
Yes, well,
okay,
exactly.
I'm mixing up the three bears that I think.
Three bears with yes, exactly. Well, Mark, here's the thing. Here's the thing, Austin, that Mark, as a new investor, really needs to understand. Again, historical data. The market falls 10% about every 12 to 13 months, depending on the time period, depending on the data. So the market, on average, falls every 12 to 13 months. If you go back in rolling periods, 10% every month. It falls 15% every 2 to 3 years, I think, 20% every 4 years, and then 10 years, every 10 years, it falls 30% or more. And of course, we've experienced very dramatic drops of 30% or more over the last few years. And then those are, a little bit more rare in the market, but they do happen. But those 10% drop assets, those 10% drops in the market, they do happen more frequently than we have seen over the last couple years. Really, up until more recently, the market has been fairly low volatility, has shown low volatility. But new investors have to, it is a part of investing. It's the reason we invest in stocks, and we expect those 10%, or we hope, again, if you invest in a market ETF, historically it has done the market has done about 10% a year versus bonds that, I'm making this number up, Asset, but maybe, mid single digits to low single digits, right? Something around there.
Yeah, sure.
And the price we pay is volatility. The price we pay for that excess return is volatility, whether you're buying individual stocks or whether you're buying the market. And it's really important for new investors to understand that.
I'm glad you imparted that. I want to impart one more thing to Mark as well. That you actually don't have a weak question. That's an expert level question.
Yeah, that's a great
this
question.
Is when you get far enough in your investing journey. And for some people, maybe who have more smarts than I ever did, Andy, that's very early in the process, where you begin to think, okay, what's the relationship between volatility and the return I want? I mean, that is a high level question. And we spend our careers trying to figure that out, right?
That is really the question. And not enough of us probably spend time thinking about that, especially around portfolio construct, because it's difficult to do, Asset.
True.
Sadif says, Fool24 almost feels like therapy on volatile days. Thank you for arranging it with Sadif. That's why we are here. That's why we love doing this and love being out there in the markets, both out on YouTube as well as for our members at Fool.com, trying to help during both good and bad days. And those days that are just kind of more like when the market doesn't do a lot. The market may not do a lot, but stocks are always doing something, and businesses are always doing something. And we're out there trying to help make sense of it all, especially in a foolish way for long-term investors, Asset.
Absolutely. I think it's sometimes therapy for us too, because we're following so many companies.
Not sometimes, I think a lot.
A lot of times, and we're exchanging notes in all throughout the day on Slack. Oh, this company's really taken off after earnings. Oh, but this one is down. And then throw in a little bit of market moodiness like we have today. And this is fun for us as well. Hey, Andy, one from Besties here. Do you see Arista Networks?
I was just going to ask you, No, I was going to ask you. I'm asking you what you think about that. So please say the question and give me your answer because I want to hear it.
I'll try it. I'm very interested to hear your opinion. Okay, Besties says, do you see Arista Networks, ANET, higher or lower in 1 year, 2 years, 5 years? So I will say my market expectation for this year, let's start with that. Andy taught me to do this, is baseline lower than the last 2 years, which means there's a potential for some tech companies I love maybe to underperform. So in that instance, I'll take an educated guess that Arista Network could be a little lower in 1 year. 2 years out, I think potential could still be slightly lower to break even. 5 years out, this business is going to be still humming along. The stock will be higher. And the reason I say that is Arista Networks has proven out that it has sort of just a long pipeline of demand. Mm-hmm. And the industry just keeps growing, whether you're talking about enterprises that are building their own networks on campus or more and more data centers where Arista plays a role. Some of the risks that we thought it was exposed to turn out not to be that big. For example, they compete with NVIDIA in a certain type of networking around AI computation, but really the main bulk of data center networking still relies on the Ethernet standard, of which Arista is like the premier supplier of switches and routers. Lastly, their EOS extensible operating system. This is the software that configures how you can use its equipment. While you don't hear so much about it today, because so much focus is on, is Arista an AI player? Is it not? It is still proving to be one of the most valuable parts of going with Arista versus some competitors. And I just see that continuing. It's an amazingly well-run company. They have so little operating lease expense on their books. They're so efficient with their capital that they will inexorably just churn out those unit economics, those business returns. And so as a function of growing cash flow and earnings, even if you have a little bit of temporary multiple compression, as Andy pointed out at the top of the show, it's a little pricey, feels a little pricey now. Within 5 years, that's going to correct and the stock will be higher. It's one of the few companies, Andy, that when I say that, I hear myself speaking with some confidence that I don't assign to a lot of businesses, but I would think that Arista would be higher in 5 years. So,
I think that's right. So it sells at, 40 times earnings, 41, 2 times earnings. And these are legit earnings, Austin. So it has high cash earnings. It's exceptionally well run, great financials, great leadership team, plays in a part of the market. They do have some customer concentration in the likes of Meta and Microsoft, which is something that I can say I watch it, but it's like there's nothing I can really do about it. I mean, it's hard to diversify away from those big players. They have a little bit more rising competition from the likes, even from NVIDIA. They're frenemies in a lot of ways with NVIDIA. They continue to bring up those great returns, but over the last year, the stock's up more than 50%. And over the last 5 years, I think it's up more than 600%. And so it's just inevitable that we'll see these pullbacks, and we've seen it's down 11% this year. When a stock gets up into like this one, even as great as it is, up to 50, 60 times earnings or 20 times sales, we're just going to see these kinds of drawdowns. But like you were saying earlier, it could draw down another 20%, and then 5 years from now, stock's at, not making a prediction, but maybe it's at 125 or 150 or something like that. And that's the nature of these great businesses, as long as they are continuing to excel into that marketplace. What's really going to propel the stock, I think, 2 things I'm looking at is, one, continued spending and wins into the data center space. But their campus business is evolving, doesn't get a whole lot of attention. We'll see how that continues to grow. And hopefully most of the growth is on the organic side, not on the acquisition side. So
awesome. And with that, I think we're at 401. Thank you for that. Those great overview of Arista. I think we both are saying that it could be some multiple compression for a couple of years.
I think it's probably inevitable, but it's not. It's just very difficult to trade around that. And I don't think we encourage that. But that's great, Asa. Thank you for the last hour. That was excellent. And if you're watching us on YouTube, thank you for joining us. We'll be here again tomorrow, and I think tomorrow and going forward. So thank you all for joining us. If you're here watching us on your Fool.com membership over at Fool.com/Fool24. Thank you. Stick around. I think we have maybe Jose and Danny coming up next. Maybe they're coming up behind us, talk about tech earnings, which I think will be exceptionally. You have a lot of good, smart people coming up to talk about lots of additional good businesses. And also, we got NVIDIA next week. So we got a busy week ahead of us.
Can't wait, actually.
We got a lot of great stuff to look forward to. So thank you for being here. Appreciate it. Have a great weekend, Austin. Talk to you later. Fool on, everybody.
Fool on, everyone.
Jose, Danny.
Hey, Andy.
How's
Hey,
it
Austin.
going?
Hey, guys.
Good to see you, Danny. I did my best to try to answer. We didn't even talk Mercado Libre, which I really wanted to, because it's one of the stocks that's up today, which is great. But we tried to talk a little bit about Trade Desk, and but I'm looking forward to hearing what y'all are talking about.
Same.
Fair
Have
enough.
fun, guys.
Have a great show, y'all. Cheers.
Well, welcome to this hour of Fool24. My name is Danny Venna, and I am joined here today by Fool contributor and really a guru in semiconductor